Good afternoon, everybody. Welcome to the Endowus WealthTech Conference, Singapore's first summit dedicated to the growth, opportunities, and challenges within the wealth tech space. It's wonderful to be with you here in person, to see so many of you in person, face-to-face, and catch up with some familiar friends, as well as join you virtually online to everyone who's joining us remotely as well. I'm Rachel Kelly. I'll be your host today. I'm from Money FM 89.3, and it's absolutely wonderful to be with you. So today we're going to touch on topics from the state of wealth tech in Singapore to rethinking the role of financial institutions, and ask questions on trending topics such as whether ESG investing is on the right track to create an equitable and sustainable world. And I'm sure many of you will have questions for our esteemed speakers today. And if you do, don't worry, you'll have the opportunity to ask them. If you log on to slido.com with the code #EWC2022, you can ask all of your questions there and they shall be answered. If you're posting on social media as well, please do tag us at Endowus or #EWC2022. Now, the Wealth Tech Conference is proudly presented by Endowus, Asia's leading digital wealth advisor. And before we begin, we've also got to thank our partners, without who today would not be possible. So our official partners, Amundi Asset Management, Dimensional, PIMCO, official knowledge partner KPMG, supporting partners BlackRock, Eastspring Investments, Family Office Association Hong Kong, FinTech Association of Hong Kong, Goldman Sachs Asset Management, JP Morgan Asset Management, Singapore FinTech Association, UBS, and UOB Kay Hian, as well as our supporting media partners Asia Asset Management, Citywire Asia, and KR Asia. With so many supporting partners, I'm sure you'll all agree that everyone has got their eyes firmly fixed on the wealth tech sector. And there is a clear and bright future ahead for the wealth tech industry. In 2021, for example, global wealth tech funding hit record highs, with funding to the sector surging 156% from the year before. So what are the opportunities? And also the challenges? Well, we're going to find out next. Our first session seeks to address just that. So without further ado, could I please invite Subnendu Mahanti, Chief FinTech Officer at the Monetary Authority of Singapore, and Samuel Ree, Chairman and Chief Investment Officer of Endowus, to the stage.
Okay, close to you, close to the wealth.
Close.
Okay.
Yeah, Sob's already trying to avoid me and my questions.
Yes.
Promise to keep it friendly today.
We will figure out end of the session who is figuring out, who is avoiding whom.
Sounds good. Thank you, everybody, for joining us today for this wonderful conversation with Sob today. It's really exciting to have this Endowus Wealth Tech Conference. I was actually suited up with my jacket and everything. Sob turned out like this, and I decided to roll up my sleeves and join. The thing is that when we were chatting outside, two of our client advisors approached us. And so I was asking Sob whether he'd opened an account and whether he needs help from our client advisors. What was your response, Sob?
I told, be careful what you're asking for. And I have a reason for that.
Yeah.
I have a reason for that.
What is that?
It's a very, even the reason why I think you exist is for that reason only.
Okay.
During the I have two wealth accounts in two banks here. One is a foreign bank, one is a local bank. And the foreign bank during crisis, 3 years, didn't call me once. Till now, has not called me once. And I guess for good reasons. I think I'm a long-term investor.
Obviously.
So I don't worry about market issues. I should know how to deal with this.
That's right.
So they're truly following my signature, which I signed, I guess. I'm a long-term investor. I can take maybe 80% wipe out of my wealth before they call me on the trigger. And the local bank, for some reason, called me not because they wanted to call me, because I went and complained about their app. The wealth app.
As the fintech head, you should.
Yeah, and the reason I actually called because they're not giving attention to me. So the best way is to complain about their app. And I went and pointed out, I can't make a head and tail out of your balance is showing sometimes shows positive, sometimes negative. Maybe you're doing something good.
Yeah.
And after a lot of complaint, they called me. Then I told no, I'm going to come to your office and help you to design this app. So that it works for me.
You volunteered your services to improve the user experience.
So I thought the reason I was putting this, because I thought it will cause some embarrassment. A real thing, what I wanted is to talk about my investment. Okay?
Yes.
So finally I got them there, and they sold me a few more.
Investment products.
Yes.
Push you some funds.
Yeah, this is going to help you to offset some of your massive losses. Okay, so, and I told, can you call me at least once in a month? And they're still trying to call, but I don't think they got that.
Yeah, they didn't get the message.
Compared to my third channel,
Yeah.
a small like financial advisor,
Yeah.
that chap calls me every month and gives me, okay, I'll move your cash to this. No risk. I mean, I feel good about it. At least the guy calls and talks to me. And somehow I feel more comfortable with this guy calling me once in a month.
That's fantastic.
And it truly shows why you should exist.
Why you need advice.
And why you should exist as an alternate provider.
Right.
Because one doesn't call me for 3 years, and other I found a way to. So before your two lovely agents call me,
Yeah.
they better ensure that they call
They'll
me
be there for you.
once in a month.
Absolutely.
Minimally.
But the experience is not something that's unusual for most people here in Singapore. And
Yes.
one of the reasons why, Endowus has embarked on this journey.
Yes.
Right? Because I think the wealth tech space is a space where, there's been very little technology adoption, and it's a very sophisticated part of the business. So it's a business that traditional banks, whether it's commercial banks or brokers, don't do well. Because I think the way it's set up, a lot of these banks are very transactional, and brokers too.
Yes.
So when you're transactional, they're doing what they did to you, which is try to push you one product, sell you a fund.
And insult to the injury, they called me that you have a custodial fee of $1,500 to pay.
Okay, we'll talk about fees later. But it's a structural problem, and that's why we need to tackle it from a systematic perspective. Yes. And I think technology obviously provides us with a lot of opportunities. Whenever we move an industry like the wealth industry from an offline experience to an online experience, the two most important things are exactly what you said.
Yes.
The user experience and cost.
I think more basic, they don't even call.
They don't even call.
They just don't even call.
I can guarantee you that Endowus advisors are going to be.
And I don't mean that they will call me a telephone.
Yeah.
At least some email, nothing.
Yeah.
For 3 years, this global bank, no email, no call. They don't know that I exist in their system anymore.
That's right. Well, I'm going to move on quickly because, no, I'm just kidding. No, but this is really important. One of my claim to fame recently is I went on a podcast and they asked me if there was one thing you would change, what would it be? And I said, I would ban all banks from providing wealth services. And the reason why I say something so dramatic and almost, is melodramatic and almost sensational is because of the experience that I've had personally using my commercial banks. My ex-company, I won't name, but, I didn't enjoy the experience, and it was very costly.
Yes.
And they don't provide good advice. And so the advice and being able to provide that advice at scale through technology is critically important for success, I think. Yeah. And to make SOP happy.
No, not me, not me happy, because let me take the third one, the small financial advisor. If he has access to technology, he had three knee surgery, still calling me once in a month.
Oh, wow.
So the thing is that if they has the right access to technology, I think he can be far more efficient.
Absolutely.
So having that lack of access to good platform, good infrastructure, perhaps these banks don't call.
Yep.
They're too overwhelmed with this volumes they have to deal with, and with 30% loss in your asset, you don't want to call your client, say, oh, sorry, long-term investor, be happy.
Okay. All right. My marketing guys are probably freaking out right now because this wasn't supposed to be the questions we were going to be talking about. But it's good. This is what a fireside chat is supposed to be.
I want to ensure audience here to hear this from me. I suffered during COVID a lack of empathy from the wealth advisor.
Yeah.
Absolutely zero empathy. And they don't have the moral courage to call you and say, look, you lost 30%, there's a macro environmental change, but here are things we can help you to think differently.
Absolutely. Zero.
I think that's the problem we've got to fix together.
We're hearing it from our clients too. Our clients are saying that their private bankers avoiding their WhatsApp message. I mean, that's how bad things are.
Yes.
But okay, so we'll move on because this is more fun, guys, than listening to what the MAS strategy on digital assets is, right? I think.
Yeah. You can understand how strategy is working.
Yeah, they can read the white papers that you guys publish and stuff.
Yeah, indeed.
So let's talk about the more interesting and fun stuff. But I did want to touch upon each of the subjects that we'll tackle today. So we threw out the original design and said, hey, we have 5 different panels today that's going to tackle private wealth or generational wealth. We're going to have ESG, sustainable investing. We're going to have WealthTech, technology. How do we adopt technology? And then the whole Web3 DeFi, how the next generation of investing, and then financial education and literacy, which is critical to achieve success for individuals and the society at large. So we're going to tackle each of these questions very, very quickly.
Yes.
And
we have 23 minutes to go.
We have, how long do we have? 23 minutes.
Yes.
Okay, we'll leave some time for questions at the end. So I hope you enjoyed these conversations, as you have so far. So Singapore is the epicenter. It's the hub of wealth industry. But yet, these frustrations exist.
Yes.
What more needs to be done, especially with regards to technology, and how do you see it as technically you're also a regulator, but you're building an ecosystem, right?
Yes,
of financial technology, and wealth tech is a very important component of that. How do you see the landscape? How do you build that ecosystem in the right way?
If I look at the numbers, it does show that the sector itself is growing. if I look at the investment numbers of the wealth tech companies here, I think the KPMG report which came out today talks about some 900%. It looks 23 million was base, and this is 163 million in terms of investment. Percentage-wise, looks good. What it clearly shows that investors are interested to fund this space. That's one thing, which is very encouraging. Second thing, I think, which we got to figure out, a lot of the financial institution which is providing this wealth advisory, they need massive restructuring, redesign of the backend platform. And this is where wealth tech companies should come in and cut it out. And I was reading a note of Mambu, where's Ned here? Yeah. So he was complaining about a 6 to 9 month sales cycle, and which is exactly the issue. I think how do we get this garbage pilot every time you do something? The pilot means what? So there's a real problem. You don't have to pilot a real problem, which you got to be fixed. So find out a way, which I think is missing in this space in Singapore, is that ability for wealth tech companies to really close an understanding with the banks here, or FIs and broadly speaking, so that we can have massive sectorial upgrade of our infrastructure, which serves the client in this market. And Singapore as a wealth hub has seen a massive growth in the assets which is coming out of here. I think between Hong Kong and Singapore, I think it's close to how much? 4 trillion of assets. And I think with let's say a couple of trillion here, the money is here. Investors are the wealthy customers are here. Not wealthy, the one below that, 1 million high net worth individuals are here. They got to have access to this tech stacks. And there's a second piece to me, which I think we got to work very hard to fix it. And third, I think the whole there has to be a reconfiguration of the people in that industry, how they think about client. In good times, a lot of calls. In bad time, they don't show up. And that's my frustration. If technology can help them to find a way to manage that relationship, build that process from wealth preservation to active market actions, or find a way to build that portfolio over time, it will be a big help for us. But I can tell the industry is growing, the investors are interested, there's real money to be made in this market. Singapore being as a growing wealth hub does make it attractive for many wealth tech companies to come here. So I hope that grows.
Absolutely. Fantastic. I'm also very impressed that you read the briefing docs and you read the KPMG report.
I have to know because it shows up in like that. I have said something to that.
So just a quick plug for the report, though. We just published it this morning. So Endowus KPMG released the first Wealth Tech in Asia report, forecasting the future, but also what are the most important drivers of success in the wealth tech industry. And Saul kindly
I normally don't do open praise of consulting company, but this report was well done. Not because I also had a picture there, but
it was also because Endowus is involved.
So ignore my picture there, rest is good.
So there's a lot of self-plugs going on right here. All right, so we're going to move on to a very hot topic, but a topic that we're kind of getting tired of because everyone's talking about ESG, right? And every fund manager, product manufacturers talk about ESG.
Okay.
So we hope to have a deeper conversation later. I see Jessica, who's going to moderate, fantastic moderator and leader in the field, with guest speakers who are going to be fantastic. But how do you see it? This
First time I'm
space?
feeling very cold. Jessica also can squeezing. So that's the first ESG thing to fix this place. Switch off this aircon.
Yes.
Okay.
Spend less on aircon.
So that's the ESG problem to start looking at. Okay. On ESG.
It's specific to maybe investing.
Yes.
And the space of fintech and wealth.
Okay. I'll come to the fintech. You got to. I think for us, we got to think where to invest. Mm-hmm. If only 5% or 8% of global industry which pollutes in some way have access, are technically called as the green companies.
Yep.
We have 90% of companies who don't have access to any technology,
yep,
which can help them to either reconfigure their systems or processes or move to alternate paths. So we have a huge gap in the real sector who needs massive investment so that they can change the way they do things today. So there's anyways huge gap out there. And for banks to redirect their capital to this sector is one thing. For regulators to expect banks to disclose their capital reallocation is separate thing. But who is going to build those technology for this sector, whether it's energy sector, transportation sector, agriculture sector, to have access to such technology, which will help them to be less carbon intensive. And those companies needs access to capital. They needs investment. And these are the real future growth investment asset, where the companies will make us green. I think that market is very, very underdeveloped today. In fact, we don't know who are these people who can fix things.
Right.
So our first effort is now to figure out, to find a marketplace to get them, at least to trace them and figure it out how to have a dialogue with them by sector, by real sector, and see whether we can allocate investment fund to them. That's stage one. On the stage two of this problem is the classic regulatory ask: disclosure, taxonomy. Looks fancy. Disclosure.
They'll explain later.
Yeah, we can explain. They're all in the books. So this is all how to get it right in front of, so that we can read this report, look at the data. The challenge in the step two is the data itself. Mm-hmm. And I was in ASEAN market last whole week. I can tell you it's very challenging to get good data set to really do a good disclosure provenance on these processes. So having access to good data set in the market around us is the second challenge we go to work and fix it.
Right.
And the third piece is all education piece. And I think there is one argument saying that consumer can change the behavior, but it's they have small leverage in this process. Very little you can do.
Yep.
You can do some cute stuff, but very little you can do in a large scale way. So for us, it's the primary target to go and build the infrastructure to figure out these companies which will look for solutions who will fix this real sectoral challenge. Beyond that, I think, so that's the first 1, 2, 3. Why fintech is a big question. In fact, it's an accidental opportunity for us as a fintech, because think about payment fintech. They process every good behavior in the world. Mm-hmm. And I don't want to be expansive what good behavior means, but you can look at the payment data and you can figure out who is putting money where, who is buying what, what is driving the economic growth. They have rich data set to really help us to build models in terms of measuring and monitoring the impact. So payment companies payment fintechs by design can be find a reinvention about themselves and call us green fintech. Of course, attract more capital now, so that they will play a key role in this process. Mm-hmm. Company like yourself, you can actually provide far more richer insights to allow people to think about moving their own investment choices, so that can be an incentive for sector to think differently. I was reading the report. Mm-hmm. There's chapter there in that report about how company like yours are thinking about incentivizing investors to invest on those assets. So that will be a good way to go look at this. So this is broadly what we are doing, but I can tell you I don't want to be caught between disclosure and registry, and as the biggest achievement we have in ESG space.
Yeah.
We have a long way to go. And I mean, I was in Philippines, 60 or 100 million people. They don't have access, some people don't have access to electricity. What green we're talking there?
Precisely.
So there has to be a transition which makes it palatable.
Yeah, at everybody's own pace. Yeah,
Yes.
depending on their needs. I guess that leads us to the wealth tech conversations because related to that, there's like 1,000+ fintech companies here in Singapore, and there's been tremendous funding. KPMG report again, massive growth in funding. But there's also, some headwinds that we face, whether it's the lack of talent, especially engineering talent. We have to fight with huge, big companies, regional, companies, and the gap with all the other regions in terms of that capability is narrowing very rapidly.
Yes.
Right. So, what can Singapore do? The talent side especially, but is there other areas where I think we can help nurture the ecosystem to scale better and faster? Yeah.
Let me give a funny story.
Yeah, sure.
In sitting in Singapore, we talk about how talent can come to Singapore. We have recently announced a very progressive EP pass, or the tech pass, all these things.
Right.
And I was in Philippines. I met this big company, big bank CTO. His opening remark is how to work so the talent don't leave Philippines. So market is thinking opposite to what Singapore is thinking.
Yeah.
So Singapore is thinking how to bring talent. Markets are thinking how not to let the talent get to Singapore. So
Especially Hong Kong these days, I heard.
So there is this massive conflicting interest in the talent space, which is good for talent. And so I was speaking to this CTO from a large bank in Philippines. They told me that they're now going to match up compensation what they used to get in Silicon Valley in Singapore as a first incentive. And to do that, they were getting very creative. They said, we're okay for the chap to have 2 jobs so that they can get the same salary. This is the extent they want to go to have access to talent.
That's flexible working.
Not only you don't have to spend a lot of money to match up to the salary, you're open to the idea that the employee of yours in tech has 2 jobs, to 1 night job and 1 day job.
Yeah.
So they get both the compensation, they do better than what they get outside here. So what I'm trying to say, the talent is what is really out there. I think we got to do better in the way we attracting talent, not only have a more progressive talent pass, working pass, but also have good jobs. You can't bring them to Singapore and give them a paper shuffling tech job. They go to write real stuff. They have to write code. They want to have a good project. So having good work, also the second layer, which I think industry collectively have to work hard. So not only we get the best talent, they also do good work, good projects, which will at least good look in the LinkedIn profile. They've done a really good job. And also we'll get them to speak at the Singapore FinTech Festival.
That's right.
And the Endowus conference here. So one is be open about global talent coming to Singapore. Be open about some of the policies around how to make it flexible for this talent to be more multimodal in that sense, and also have good jobs for them. We are very sure that there'll always be a big gap. And the answer to that is not more salary. I mean, that is good for a lot of people, for me also. But that's not the right answer, that you can always compensate for talent gap. Because people really want to go back to wherever they came from. They want to make an impact, especially the programmers who are in 40+. They are not interested only money and work. They want to also give back. They want to make a real impact in the country where they come from. So you will see a lot of reverse talent going back to this country, which is a worry for us, also not a worry, because we are happy to work collaboratively. If you have Endowus here and you have a center in Philippines, work together. Absolutely. We don't have to have every talent sitting in Singapore doing the job. We can have a network of collaboration and this opportunity to work together. So collaboration, perhaps the ultimate answer to this talent issue. It cannot be a single center have access to all the best talent sitting physically in Singapore. Not possible.
Absolutely. I have a good story to share with everybody with regards to SOP. When I was at Morgan Stanley, before I left, I went to a Goldman Sachs TechNet conference, which is an annual conference in Hong Kong. And this was back in, 2016 or
I
it was soon after you joined?
I tend to forget all my statements.
Yeah. You'll deny it to the end, but
Yes.
I'll tell you what happened. So I attended the conference, and I was still at Morgan Stanley, and I saw this new fintech guy dressed like this in jeans and a shirt and a jacket I think you had, with a Hong Kong fintech person head. And you guys were talking, and they were sharing good insight, both sides, but then Sop was saying how he's created a WhatsApp group in Singapore where all the fintech leaders and guys come in and they chat and they can share grievances.
And they abuse
and
me.
Complaints, yeah, abusing Sop right on that WhatsApp. And then he said, okay, and then he's decided maybe we should invite them to MAS. So we had some wine, we had some, drinks, and we chatted and had this engagement. And the Hong Kong guy, his response was, he said, are you guys allowed to have alcohol in your office? That was the extent of innovation that he was excited about. So I'm not trying to bash Hong Kong, but this is a problem with a lot of regulators, and why Sop was so refreshing when he came to the scene, because he's from the private sector, right?
No,
and within this context of fintech, I think, yeah, sorry, you were going to say something?
No, I think that I tend to forget all this incident because Hong Kong is still a great friend of ours.
Yeah, yes, of course. Yeah.
We want everyone to succeed,
Yeah.
because, as I said, the talent is an issue. Not a single center can access to all talent.
Yeah, but that was my point, that actually it's about being open-minded,
Yes.
being flexible, being
Yes.
collaborative. There's a way to solve the problem if we can just look
Yes.
beyond just territorial. It has to be all based here in Singapore, has to be homegrown companies only, it has to be Singaporean founders only. So
Yes.
if we can be a bit more open and flexible. That's,
And I asked the CTO that what you're doing to stop people going to Singapore. I asked that question last week.
Yeah.
And he had a lovely long answer, but not for today.
Which leads me to the next topic, which is a lot of discussion, and we had a media session this morning with some media people.
There's no
on
media here,
KPMG.
right?
Maybe they might have squeezed in, but
Okay.
it's okay. You don't care anyway. I know.
No.
But there's nothing off the record, Sop, anymore.
Yeah,
this is
indeed.
on YouTube. Like,
Oh, my goodness.
but
Okay.
I was going to lead to Web3, DeFi, next gen, crypto, that whole space. And,
Yes.
and to be honest, in my view, and I look at the whole fintech space, MAS has done a fantastic job in nurturing the ecosystem, and yet be a good regulator that has protected investors and retail investors and individuals in particular who need that protection. So you've found this good balance, but this is a space that's still nascent but exciting. A lot of people are involved. A lot of people have lost money. They should have just put their money in Endowus, but that's another story. But just generally, what are your thoughts, and where does the future lie? Is this a pause that refreshes, or the end of?
Is the last question or the second last question?
There's one last one on education. And
I'm looking at the time.
Yep.
Okay. So, well, Ravi Menon just made a policy, not a policy, a clarification speech on where we want to go. We have broadly one or two areas to focus on. I think we're going to support digital asset growth, no doubt about it. And in our mind, there are two big buckets in this space. One bucket is what we call as a fungible assets, cash-like. There's a cryptocurrencies, private currencies. There's stable coins. There's central bank digital currencies. There's a tokenized deposit or banks issued cryptocurrencies equivalent. I think cryptocurrencies, our stance is very clear. We don't know why it exists, but there's a lot of speculation. Stay away from that. Very bad area to go and think about it. But we do recognize there's a need for a digital currency because in the Web 3.0 design of the future, you need a new form of money which can allow you to buy and sell things on the marketplace, which is in a way a payment instrument and a contract of ownership transfer happening in a single transaction. For that, you need a new form of money, and digital currency is a way to do it. Whether it's a stable coin or a central bank issued currencies, or it is bank issued digital currencies, we need some of them to be part of that process. On the opposite side, on the marketplace side, you have the whole range of non-fungible assets, which is nothing but what you are selling today, asset ownership, whether it's a bond, security, equities, real estate. In this new world of Web 3.0, there's a new ownership construct of how to own this asset, which is a distributed way. And I think that market will grow. And we are happy to see whether some of the wealth tech firms are going to focus on that asset class and see where it goes. So we got to recognize that. We got to find a new form of money, which is safe, which act like a real currency, and then they can transact and allow people to buy these assets, which is the non-fungible assets, which represents all the real economy assets as in different ownership design. So that's our view. I will repeat again. We are very, very serious on our stance on the speculative aspect of cryptocurrencies. We are strongly advising retail investors to stay away from it. It is just a disaster. You've got to stay away from that. So that's our view.
Yeah, related to that, and it's related to the financial literacy topic that we're discussing. The top question among the audience is, how does MAS intend to regulate fintechs and $0 brokerages where many fees are not transparently displayed? And then there's another question, should the MAS introduce the legal definition of fiduciary duty to the FAA, similar to the US, so financial advisors have to legally protect client interest? A lot of this is kind of related, and how can we use technology to improve this?
It's a good question to have some policy stance on that. I think very good questions. If I can have access to the question after this,
I'll send it to you.
We'll take it and we will try to make something out of this.
Absolutely.
I think broadly speaking, I think the whole literacy part of this, especially if you are going to democratize access to wealth to more people, I think you got to start thinking seriously about literacy. And anytime somebody says how a digital bank going to make money, I said that you cannot make money by processing payment is out of question. Your ability to make money by lending or digital finance is getting maxed out because huge competition. What really going to make digital bank profitable, which we are not sure, because based on what...
There's a question on that. What advantage the regulations of digital banks have over the competitors?
So the only way in my mind, it's my view, not MA's view, is to figure out how to be a more efficient distribution channel for affordable wealth product, affordable insurance product, affordable pension product. That today banks just don't do it. They don't call after 3 years. So forget about calling for a micro wealth product. They'll never call for the rest of the life. So having an opportunity for a digital bank to work with a company like yours, so we are okay, 2 minutes. So having that opportunity for the digital bank to offer this 3 set of product, insurance, wealth product, and pension, on top of lending, on top of payment processing, is the way to go. So we have 20-odd digital bank licenses issued in Asian market. All are going to compete. It's a perfect storm for all WealthTech company. Go and talk to them, find a way to partner with them, make them the most successful banks ever we produced in the sector.
So that is really important, because the banks, even digital banks, are focusing on areas which are not really wealth. It's really the day-to-day.
So if from year from now, if I have to look at all the digital banks, I want to see how many of them have partnered with WealthTech companies for the wealth side, insurance side, and the pension side. If they get it right, they will get it right on a long run. If they're going to be obsessively focused on doing lending, God bless them.
God bless them. And that's interesting because, we can't disclose names, but we have been approached by digital banks to collaborate across the region. And you can see that only the guys that are really thinking through their business model and preparing for their future are the ones that have really thought this through and approaching us. So that's interesting to hear.
We are done.
That's right. So I was going to wrap up anyway. Thank you guys for listening. Thank you, Sop, for being here with us with really insightful, frank, open discussion.
Thank you, everybody.
That was indeed a very insightful discussion. And if any of you don't have an Endowus account, I believe those 2 ladies are waiting outside for you. No, I'm just kidding. Okay, but a lot to take away from that, from the need for quality data to the flood of ESG investment products that we're seeing in the market. And I'm sure all of this is going to be covered in the coming sessions as well. And that leads me to the next session. We're going to be discussing seizing new opportunities in the burgeoning private wealth space in Asia. To help us do that and to tell us how we can seize those opportunities, could I please invite Samuel Reed, Chairman and Chief Investment Officer of Endowus, back to the stage. He will be joined by Joe Teasdale, Head of Wealth Management Group, VP Dimensional Fund Advisors, Patricia Kwek, Managing Director, Head of Wealth Management Singapore at UBS, Marcio Bogoristin, who is the EVP, Head of Asia Wealth Management at PIMCO, and Edward Moon, Managing Director and Head of Asia Pacific Global Wealth Management at Apollo. Please join us on the stage.
I'm pretending to be a different person with a jacket now. Yeah. And the reason I'm moderating today this session is because the person that originally was supposed to moderate had some personal reasons not to be here. So I gladly took up the opportunity. My marketing team said, maybe we should find another moderator. I said, no, I'm going to do it. I want to talk to these guys. So thank you so much, guys, for being here. Maybe, first of all, I mean, it's a very broad, big topic that we're going to cover today, private wealth. And you have no better people to discuss and share insights and thought leadership than the four people here. They all represent different kind of segments of the wealth business. Patricia, obviously. Maybe we can start off, actually, with a brief introduction. Should we start from Ed on the other side with... first of all, let's combine a few things in the interest of time, since with SOP session we ran out of time pretty quickly. So we're going to combine the self-intro, a quick intro of your company, and I'll ask each of you to comment on the first question to save time. And that first question is, private wealth management has traditionally been based heavily on trust. And in the past, people have thought that high touch and relationships is what drives engagement with clients. And was seen as the only way to build trust and service clients properly. In today's world, trust is still paramount, but since this is a WealthTech conference, let me ask you, how can the industry tap technology and digital tools to continue building trust and relationships? How is digitalization driving your business priorities today? Businesses priorities today, sorry. So we're going to start with Ed. Self-intro, company intro, and a brief discussion about how your company is tackling this digitalization.
Sure. First, thanks, Sam. I've known Sam for too long, 20 years plus, and thank him for inviting me today, and really to congratulate Sam and Endowus for all that they've achieved so far. So my name is Edward Moon. I head the global wealth business in Asia Pacific for Apollo. We are a premier global alternative asset manager, managing $513 billion in AUM, over $500 billion since 1990. So for 32 years, heading into our 33rd. Really, quite simply, we provide excess return, or we seek to provide excess return all along the risk-return spectrum, from safe investment grade all the way up to higher yielding private markets or private equity. And for us, this is a forum that probably 5 years ago Apollo would not have attended. So, just to really paint the landscape of how the landscape has changed. Apollo was typically investing, and in many ways indirectly, for a lot of private wealth clients through we count amongst our LPs, the largest sovereign wealth funds, endowments, pension funds in the world. Today, we see the tremendous growth in the private wealth space, number one. Number two, products that we are bringing to market are really tailor-made for the private wealth segment. And in the intersection of that is really where Endowus sits. That is, we feel that there are secular forces that are tremendous tailwinds for where we sit today, which is the democratization of finance and creating frictionless kind of ability for us to bring our products and service a wider range of clients. on that front, Apollo has been on the front edge. We have invested and tried to future-proof our business. We've made investments with iCapital. We've made investments in Figure and Motive. These are blockchain technologies, not to really try to pick and choose the winners or losers of that space in particular asset classes, but we understand that the transformational way that fintech is going to really change the way that financial products are consumed going forward. We want to play a leading role in that front. So that's the first kind of introduction of what we do, and we look forward to working closely with Endowus and your partners going forward as well as we serve our clients.
Thank you so much, Ed. Marcio.
Great, thank you. Thank you for having us, and congrats on all the great milestones Endowus have been achieving. It has been great to be with you guys since the beginning, so very happy to be here today. My name is Marcio Bogoricin. I head Asia Wealth Management ex-Japan for PIMCO. For those who don't know us, PIMCO, we're the largest active fixed income manager in the world. And when I say fixed income, really from the private to the public spectrum. Going to your question, we think relationship and trust is very important for the wealth business. The way we think about it is, how digital tools or technology can help enhance that trust and that relationship. So in a recent study, EY study, it said that 30% of clients will be moving their assets to another provider in the near future because they feel that the current provider, they don't understand their objectives and goals, right? So how can we think about technology to help enhance that trust and relationship? If you had a tool, and back to the fireside chat, if you had a tool where you could put together a portfolio, you could stress test that portfolio, you could go into the risk factors of that portfolio to really see if you're going to meet the client's objective, we think that would actually enhance that relationship and enhance trust. So that's how we think, digital tools could help with relationship. From our side, just some stats. About 1 in 4 employees at PIMCO work in technology. Wow. We have been investing this year 20% more than we did last year. So we think about people, platform, and also infrastructure, and also focusing in 3 areas, which are client servicing or client experience. The second one is alpha generation, how you can be better investors using technology. And third is really infrastructure and how you bring all of that together.
Wonderful. Thank you, Marcio. Patricia.
Thanks, Sam. Again, thanks for having us, Sam and Endowus, and it's great to see everyone in person. My name is Pat. I head up Singapore, Malaysia for UBS Global Wealth Management. For those of you who don't know UBS, we provide financial advice and solutions to individual investors, institutions, as well as corporates across asset management, investment bank, and wealth management. These boys here, they are partners to us, if I can say that. And we actually operate, we're quite global. So we manage about $4 trillion across Americas, Europe, as well as Asia Pacific. And in APAC, we manage about $500 million across Singapore and Hong Kong, which are our 2 booking centers. And on the question of digital, our business, wealth management, is one which is very high touch, very high level of engagement, and a lot of it is predicated on trust. So nowadays, tech and digital is actually quite critical for us because through tech, we're able to develop what we call multi or omni-channels of engagement because next gens, they're not all about touchy-feely, it's high touch still, but I think our next gen want to interact when they want to interact. So we need to pace ourselves to interact with them whenever they want to. So one of the things we do is, for example, family offices, they trade via our high-speed execution platform through what we call PET, and they trade through Bloomberg with us. For wealth management, we provide digital banking platform where clients can do various different types of trades from FX all the way to funds. And I think one of the other things we do is also called My Way. So My Way is a tool that allows investors to select any type of investments they want and build a portfolio which is tailor-made to them. And you might know that UBS Singapore has built what we call Circle One. Circle One is an app, and that's actually something like a Netflix. So you consume information on the go, right? You think about it, for a lot of you who are familiar with wealth management business, you've always received research write-ups from your banks, right? How does it come? So in the old days, the research write-up will come via fax machines in the really, really old days. And then your research materials get sent via emails. And recently, it gets sent via mobile app. So what this tries to do is, it's videos. You just watch videos on the go. So back to you, Sam. Basically, I think there's a lot of needs that we can address via digital tools now, and pandemic has really accelerated the whole adoption.
Thank you, Pat. Okay, Joel.
Thanks, Sam. Wonderful to be here. So my name's Joel Teasdale. I'm the head of Wealth Management Group for Dimensional Asia ex-Japan. For those of you who don't know who Dimensional Fund Advisors is, we are one of the world's best kept secrets in terms of large asset managers. I think we manage, give or take where markets are at today, I'm not sure, probably about $700 billion US. We're a privately owned firm based in the United States, and we have a 35-person office here in Singapore, have had for 10 years. And our investment approach, well, we describe it as low cost and highly diversified systematic investing. In years gone by, it used to be factor-based investing. Before that, it was, the people who started the firm, pioneered the world's first index funds in 1971. So we know quite a lot about running money systematically in a low-cost way, which has always been heavily dependent on good technology. And so I guess the partnership that we've had with Endowus, which has been tremendous, and I think this forum's been a long time coming, where we can talk about the changes that are happening in the wealth management industry, not only in Singapore but globally. And as the world's third biggest financial centre, Singapore plays a key role. And so our observations are that around the world in the private wealth space, there's been a trend for probably 20 or 30 years for people to look for lower cost, more reliable, transparent vehicles for investment, and the market is flooded with them. And there's so many ETFs and index funds and other solutions. The challenge has been, I think until recently in the advice space, is that everyone's there to sell product and to sell return. You don't do that, right? You have a technology platform that enables advice-led, good, goals-based outcome for clients. And so for us, the observation and learning is that it's not about the product, it's about the people. And how do you digitize advice in a scalable way where you can give people great access and more personal attention through a digital way to have good investment outcomes through, as you say, financial literacy, through discipline, and through understanding how capital markets work. So that's been the big change, I think, happening in Singapore. You're at the forefront of it, and I think there's a lot more traffic to flow that way.
Yep, fantastic. Thank you, Joel. Well, amazing answers. These guys came prepared, right? I'm going to turn to Patricia. We're going to dig a little bit deeper. Patricia, first of all, it's great to have you here, considering Endowus and UBS's special relationship. UBS is a shareholder of Endowus, but we're also, working in partnership and strategically to see how we can work closer together. So thank you for your support. I know that also that you're very particularly passionate about two groups of investors. The first is the rapidly growing family office segment, and we talked about the generational wealth that's happening. Almost, I think, $5 trillion of wealth will transfer to the next generation over the next decade. So this new generation investors obviously have different investing attitudes compared to their predecessors, want a different experience. The second group is obviously female investors and their needs. How are these two major segments of the private wealth market doing? What is important to them in your mind? What are you seeing? And what is UBS doing to meet their needs?
Wow. There are many questions in there.
Big question.
Yeah, but just as an observation, right? We talk a lot about wealth and women as a growing segment, but across the audience here, I think it's only 1 in 4 1 in 5 maybe that are women.
Yeah.
Very much like what we have on the panel. So that has to change.
Yeah. we avoided a manel, just about. Thank you, Patricia.
So globally, I think first I'll start by sharing some of the key trends, and then you can see how the products will develop, the solutions will develop. So 4 in 5 families, maybe as a show of hands, who are from family offices here? Anyone from family office? Too shy. Okay,
Shy.
you've got a few family offices here. Yep. Thank you. So 4 in 5 families say that growing wealth remains their biggest priority. So interest rates, inflation, geopolitical risk, higher valuations are key concerns for them right now. And bearing in mind as well, if I look at the people who raised their hands, the new higher interest rate environment is a new normal for families who have just invested since the global financial crisis, if you think about it, right? And as a result, family offices at the moment, and I think into the next 12, 24 months, they will review their options, and they are looking for uncorrelated returns and more active strategies. At the same time, families are also looking at investing into alternatives, such as private equity, with the potential for higher returns compared to public equities, and that's music to your ears, I'm sure. Broadly speaking, alternatives represent about 40%, thereabout, of family office portfolio, with private equity allocations set to rise further into the next 5 years. And for UBS, these kind of families, we advocate that they think about their investments from from endowment-style portfolio, what we call ESP. And this is basically a call for higher allocation to alternative asset classes that will give you enhanced returns with better adjusted risk over a period of time. And for those of you who may ask, what is alternatives? Because 40% is a fairly large allocation. So alternatives would constitute private equity, private debt, private real estate, direct investment, as well as ventures. And therefore, from a perspective of WealthTech, actually the democratization of private equity availability, right, on fintech platforms like edX, OE is seated right there, certainly adds to the accessibility of such investments for families and women. Now, our families are crypto curious, right? Just now we touched about crypto with the previous speaker. Now, we may think that a lot of families are investing large amounts into crypto, but the reality is most families are crypto curious rather than crypto committed. So they are investing in DLTs, blockchains, rather than large amounts into crypto because they are there to learn instead of to earn. So allocation-wise is still very small. Family office would also want to invest sustainably, with half of them having more sustainable investments in their portfolios. And you can hear from Jessica later that voices of our next-gen investors are getting louder and louder where family investment decisions are concerned. Now, I quickly segue into women, okay? 1 in 2 new wealth owners will be female over the next 10 years. And the CAGR growth of women will grow more than men. So you're looking at ballpark growth of 8% in women wealth versus 5% in men. And in 2016, just to take a step back, right, women control about 30% of wealth, but that will grow to about 50% by 2030. So if you're not catering to women's wealth right now, message is very clear. Now, 75% of women under the age of 45 are already managing their own money. And I think one of the key things about women is this, okay? Women are interested and they find affinity in investing into areas where they care about: healthcare, children, education. And one of the key components is women are very tech savvy. So this is where fintech will play a very big role in how we develop the family office as well as women wealth over the course of the next 10 years. But certainly, one of the key things is also this, that, you often go to conferences or meetings and you see the client. You always think that the client is a Mr. and the wife is the wife. You never bother to ask about the wife's name, if she has, So I think that dialogue, that narrative will have to change.
Yeah.
Back to you.
Thank you, Pat. It's encouraging to see that Endowus actually has almost 50% of our client base in female investors, which is fantastic to see. Also, women are, I guess, more driven towards goal-based investing, right? Because they see tangible goals that they strive for.
Correct. Yeah.
Which brings me to
And
Joel.
statistically better investors.
Statistically better investors.
better.
Yeah.
Well, I didn't
So
say that because
ego-driven.
there are too many men in the room, but yes,
It's okay to say
Can't
that. I
argue
used to
with
say
the
that all
data.
the time.
statistically proven,
Yeah.
women are better investors. Yes.
Which leads me to Joel,
Empirical.
and to Sob's experience as well. How do we do advice better?
How to do advice better?
Yeah.
Number one, you get rid of the conflicts of interest in the business model.
Yep.
I mean, that game's been changing for 30 plus years around the world. I think sometimes that's regulatory driven, like you saw in Australia or the Netherlands or the UK. I think sometimes it's market driven. Well, they didn't change the law in the US. Consumers voted with their feet to be dealt with by an advice professional in a fiduciary manner rather than be sold to as a brokerage. If you look at the amount of money flowing into the wirehouses or the banks in the US 15 years ago versus today, it was minuscule, and now it's probably more than 50%. I haven't seen the latest data, but I think that's the number one. The second thing, and the law doesn't have to change.
Yep.
You just have to let people know you're on the map. I mean, I remember Dimensional for years and years was trying to look for entrepreneurs who had a fee-based model, who wanted to do things in their client's best interest, do good and do well. And it just took a long time for that to happen. But over the last decade or so, there's more and more fiduciary-based advisors whom we're huge advocates of because it leads to better advice outcomes. So I think the more that you can make people aware that there's an alternative to just having an advice relationship where you pay transactionally, that's huge. And the other part of it is helping people understand how capital markets work and what they are in control of and they're not in control of to be successful. So I think the platform that you have, which is goals-based, which is educational, which is transparent, goes a long way to affecting those outcomes.
Right.
The last thing is we need to train many, many more good advisors. And sadly, there's not enough probably anywhere in the world, let alone in Singapore. Lots of good salespeople, but from a technical capacity and being able to give holistic advice, we need more. We need more.
Fantastic. Thank you, Joel. Moving on to Marcio. As a fund manager working with partners like UBS, we found out that Pat is actually a very important person on this panel for various reasons, but also because we all work with UBS and Endowus. What are your thoughts about the pace of the transformation, and especially PIMCO? I mean, does a lot of stuff that you said, but in the end, you're an active manager, right? And investors want good returns. So how do you reconcile these two things in generating alpha and better outcomes with the client experience and the role of technology?
Yeah, no, that's a great question. I think, as I mentioned before, about 1 in 4 PIMCO employees are in technology. So this includes, quantitative research, AI, machine learning experts, as well as technologists globally. And our CEO, Manny Roman, he thinks that you cannot never overinvest in technology, and that's why we continue to invest a little bit more every year. Going back to your question, I think there are 3 things that we're doing. The first one is alpha generation. So I'll give you an example here. The first one is we have a database of 200 million mortgage loans in the US and borrowers' profile. So we have a tool where we can understand which types of loan will prepay, which types of loan will default, which type of borrow profile might prepay, which type of borrow profile might default. So whenever there's a new issuance or we have a new mortgage pool that comes to our desk, we can very easily and effectively know what percentage of it might prepay, what percent of it might default, and we can be better investors making better decisions using a tool like that. A second one is, when the Fed used to speak, there will be many people at PIMCO looking at what words that they added, what words that they deleted. Is it hawkish? Is it bearish? And now there's an AI machine learning tool that we use that we put the Fed speech into it, and it will tell us what words were added, what were deleted, what sentences were bearish, what sentence was more bullish or dovish or hawkish. So these are things that it will help us be better investors. They're not making the decision for us, but it will help our PMs make better decisions. So that's on the alpha generation side. And the client experience side, we're launching a tool called PIMCO Pro here in Asia. We have this tool in the US. And this is really getting our in-house analytics that we used to utilize for our institutional clients and putting in a web-based application where our clients can go in, they can build a portfolio using PIMCO funds, third-party funds, ETF. They can stress test the portfolio. They can go into risk factor, correlation of the different funds and assets. And this is something that the good news, it's free, it's easy to use, and we think that it will really enhance client experience. So if you're an advisor, if you're someone sitting in a home office or a research team, you can really use that as a tool. And we think that will also enhance our client experience. And the last thing is infrastructure. And I think that's maybe the less glamorous part of technology, but how do you bring all of that together? Where do you put your data, how to retrieve your data, how you make your systems to integrate and operate all together. And I think that's another part where we continue to invest.
Okay, wonderful, Marcio. Lastly but not least, Edward, the topic of alternatives, you just received a wonderful endorsement from Pat on that sector in private markets. And a lot of people may not know, but Endowus obviously also provides access to private markets and alternatives. ADEX, we have Moonfair, B2B players like iCapital and Antarctica, a lot of players in this space. And it's a burgeoning space, but very early, lack of technology. Just wanted to ask you, you have experience actually on the buy side as well, because you were previously at HSBC, head of alts and Bank of Singapore. So you've been on both sides. So just any major observations about the major trends with regards to this sector that's, an exciting sector that's everyone's talking about these days?
Absolutely. First, I'd be remiss if I didn't thank Pat as well. We are very strong partners with UBS and thank them for their support as well. So first, I'd like to, when Sam and I sat down and he asked me to sit on this panel, he asked me for one thing, which is to try to demystify alternatives. And if I do one thing today, I hope I'll try to do that, which is, what are alternatives? Alternatives is simply the private market's equivalent of all the asset classes that every investor really is familiar with, which is equities, credit, and real assets. And if you take a look at the largest, most sophisticated investors in the world, sovereign wealth funds, endowments, pension funds, insurance companies, they have for decades been invested in large numbers, and some of their portfolios are 50, 60, 70% in alternatives. And so what's exciting today is that for the first time, alternatives, that world is opening up to individual investors. So I saw this article last week. The 60-40 traditional portfolio is on pace this year for its worst year since 1936. So almost 90 years. And if you think back, what was the point of a 60-40? So that's 60% public equities and 40% public bonds, is that there was a time when this was less correlated, when stocks were up and bonds were down and vice versa. 2021, the correlation between public market equities and bonds reached nearly 90%. There is no diversification. So if the 60-40 portfolio isn't dead, it's certainly on life support. And it's something that we've been saying for a long time, which is there's very little alpha left in traditional markets. Or, to put it another way, in a market where, since the GFC, central banks have really flooded the market with tremendous liquidity in a low interest rate environment, has helped buoy traditional assets. That has ended. And we are now seeing a rising rate environment that's very, very challenging. Additional return on equities, which is still fairly highly valued, and then for income-related strategies as well. So how do you solve that challenge? Well, private markets is one way that we believe to be a robust area where there's, number one, very low penetration by traditional private individuals. And today we have products now that we're bringing to market through our partners to be able to deliver these solutions as well. The other point I would make is that if you wanted a large, diversified exposure to public markets in the US, you would invest in something called the Wilshire 5000 Index. This is the total market cap of all the publicly available traded stocks in the US. It's called Wilshire 5000 because there used to be 5,000 publicly listed companies. Today, it has about 3,500. The number of listed companies has gone down over the decades for a number of reasons. There's been acquisitions, companies are going private, companies that are staying private for longer. The most dynamic companies, such as Endowus, these are private companies. How do you get exposure to these companies? One of the ways to do that is really to invest in experts that have been investing in decades and delivering returns at top decile, top quartile returns. That's the real trick and the challenge. When you are investing in private markets, you want to invest with the best and that have been doing it for decades. And we believe that, again, we provide a tremendous opportunity to marry those solutions to clients that are looking to, really achieve better outcomes for their portfolios going forward.
Thank you, Ed. In the interest of time, we're actually running out of time. So quick fire question. Does alternatives still make sense net of all the fees?
Absolutely.
Okay, done. Okay, we move on. Joel.
Fees are a good question.
Current wealth industry in Asia is sales-based advisory. What will it take to pivot to advisory-based sales? Or advice? I don't know. Does that make sense? Advisory-based sales?
Can I just supplement my answer really quickly? Very quickly.
2 seconds.
So as you know, I moved from Hong Kong to Singapore, back to Hong Kong. I've returned back to Singapore. And I had what is the equivalent of the CPF in Hong Kong, which I could have cashed out as I'm permanently leaving Hong Kong. I've left it because it's a passive investment. I'm down in that. And there's no reason why I don't need the money right now, so I'll just leave it. I would have been much better off had I invested in our own products or alternative products in the end.
Another plug. Okay, go, Joel. Quickly. Advisory-based sales, how do you achieve?
How do we achieve it? I think we need more entrepreneurs to do what you have done and provide an opportunity for investors to get advice another way, which is to pay for it as like a professional service, as you would an accountant or a lawyer or anything else. So that's the first thing. And the second thing is we need to put investment solutions on the table that can actually achieve goals-based advice, because far too many people just don't even get the return of the market and they don't know they're entitled to it. So you need to put a light on that. Okay.
Anything to add? Or quick 5 questions on Pat, Marcio. Is ESG real? Investing real?
Yes.
Set up the next panel. Yes.
Yes,
Okay.
it's real.
I mean, for us, we respect the clients, right? There are some clients that like ESG, and for clients that like ESG, we have ESG funds for them, and clients that ESG might not be their biggest priorities, we also have funds that do not have ESG tilts. In general, we do have an ESG framework into our investment process, but I think we need to respect the client that some clients want ESG and some other clients don't want ESG, and I think we have to cater for both.
And when Pat said yes and she smiled, it means she's seen massive inflows into ESG products. Is that?
Yeah, so I think from an investment standpoint, we started maybe 3-4 years ago with what we call the SI mandates. That was about $1 billion inflow in the first year. In the last 3 years, we are now at about $5.4 billion. So I think there's a lot of interest and demand going in. And this is particularly for families where we see the younger generation coming in, because that's what they are asking for. And it's true that for some of our clients, right, like you said, they don't think it's important, but I think more and more the writing is on the wall. We will get there sooner or later.
Okay, with that, thank you so much, Joel, Pat, Marcio, Ed. Wonderful to do this panel with you guys.
Thank you. Thank you.
Interesting themes that we're seeing weave through the first and the second session, coupling tech with trust and touch points for clients, as well as ESG. And we're going to take a deep dive into ESG investing next with this next panel we've got coming up. We've all heard about it: environmental, social, and governance. And I think you'll all agree that it has really gained greater momentum over the last 2 years on the back of the pandemic. Everyone is looking to combine profits with purpose, but can they do that? We're going to find out. If I could now invite our next panel session on to the stage, please. We're going to be moderated by Jessica Cheam, who is the founder and managing director of EcoBusiness. She will be joined by Sylvia Chen, who is a senior sustainable officer, ESG research and engagement at Amundi, with Prof. Dave Fernandez, director SMU Sim Kee Boon Institute for Financial Economics and co-director Singapore Green Finance Center. Chitra Hepburn, who is the head of APAC ESG and Climate at MSCI. And if you do have any questions, don't forget you can ask online. And if you are, you can head to slido.com and look for hashtag EWC2020. With that, I will leave it to our panelists.
Thank you.
Thank you very much for the introduction, Rachel, and good afternoon, everyone. My name is Jessica Chiam. I'm the founder and managing director of EcoBusiness, and I'm really delighted and thank Endowus for this invitation to moderate this really interesting panel. I feel like I've been given a gargantuan task, given that SOP and Sam has mentioned ESG so many times, and there's this sense that there is maybe some ESG fatigue. But I think that in this panel, we're going to really kind of offer some new insights that provide you with the perspective that we cannot have ESG fatigue, and it's relevant to us today. Also, one point to note, the private wealth panel, majority men, ESG panel, majority women. I don't know if that's a reflection of how men and women think about ESG investing, but I think that's something to reflect on. If I can just, open this discussion really with just a very quick context. Why is ESG investing important to all of us today? I think if you look in the newspapers, you can see that the cost of living crisis is something that is really kind of affecting everyone in their daily lives. And this has been predicated really by the triple whammy of the COVID-19 crisis, climate change, as well as geopolitical tensions, including the Russia-Ukraine war. And I think that it's really interesting how ESG investing has evolved over the years, because it used to be a fringe issue, and then it became mainstream, and now it's being hijacked by the political parties, and we're having a really interesting discussion now about how ESG is effective or not. But I want to quote something that it really resonated with me in this WWF documentary around our business, and that really is, there are no jobs on a dead planet. And so ESG investing is relevant to us today, because if we do not have guidelines for responsible investing, there will be nothing for us to invest into in the future. And I'm really delighted to have with me today on this panel some really eminent speakers in this space. And I'm just going to deep dive into it, as we have a lot to cover in just a short 30 minutes. Sylvia, I'm going to start off with you. How have the attitudes of investors been towards ESG evolved around the world, and especially in Asia? And have you seen this momentum kind of growing? And what is your overview of where it's heading as well?
Sure, thanks, Jessica. I'm happy to be here. I'm Sylvia Chen, Senior Sustainable Officer at Amundi, Singapore. So for me, within the ESG ecosystem, for my scope, I look at green bonds, social bonds, sustainability bond space, as well as part of the Asia transition, because it's such a huge space of where I'm located in. So for that questions, Jessica, it's definitely very interesting. For the past few years, you'll be amazed. Just as recent as last year's, their clients even asking, what is ESG? And is it really important? And how is it not sacrificing the returns? So really have to show evidence during some of the market volatility that ESG investing is sustainable, is less volatile. Although, again, this year we're seeing huge volatility across pretty much all asset classes, and yet energy, a lot of the ONG or energy sectors actually outperform. But we believe that it's a short term, it's temporary responses, not to add it to our long-term commitments within the ESG space. So I think for the investors, especially for Asia-based, we see that transitions moving away from really the basic of ESG onto more specific questions, deep dive into actually what matter to them from the ESG perspective, what is their objective, and what is required for them to get there. A lot of time, if you look at the large asset managers, the trend we're seeing, also what we observe, is a transitions moving away from exclusionary. So you probably heard of the normative basis or those principal basis in terms of exclusions on the sectors or in terms of the ratings, onto ESG integrations. What are the different ESG factors that are critical into the whole investment processes and decision makings? And actually, the lately talks about thematic engagements or thematic strategies as well as the impact. So we are trying to quantify what is the real world impacts and what does it matter to the end consumers. For the talks about ESG, they may not understand that's relevant to them. But if you tell them about, the number of trees that you saved, the number of affordable housings that you can provide, those are more real terms and more they can relate it to. So these are the trends that we're seeing in general on the broad basis. There's also another interesting trend we see as they touch on, the younger generation of investors. We recently did a survey in partner with Business Times. So what we did find out is actually for the Singapore-based investors, there's a shift toward the younger generations, and actually their focus is more toward the social causes. You'll be surprised because you would thought Singapore, inequality may not be as big of an issue on the surface, but actually that matters to them, close to their heart on the social causes for the younger generation, be it the Gen Z or the young millennials. So those are the interesting findings that we're seeing and would like to share as well.
Thank you so much, Sylvia. I think you highlighted some key points about its evolution, and I think one of the points that we want to discuss here today is the changing regulations. Because if you look globally, obviously Europe has been way ahead, and it has been issuing, the Sustainable Financial Disclosure Regulation, and it's been ranking different asset classes or investment products as light green, dark green. And then we've seen the backlash against greenwashing as well, where we have, Deutsche Bank being raided by the police for greenwashing, and then actually some money managers removing the ESG label because they don't want to be called out for that. And in this, context of the lack of comparability of ESG ratings, I think Sop mentioned in the fireside chat about the data set that is so necessary. Perhaps I can, ask Dave to give us your view, from the academic perspective. How can academia help to bridge the ESG knowledge gap, or maybe the industry in general help to improve ESG data so that this movement can become further mainstream and more entrenched with, science-based and good decision-making behind it?
Well, thank you for the question, and thanks for inviting me to this panel. I'm so happy to be adding diversity to this panel, and by that I mean having someone who's not part of directly the financial sector, having an academic here on this panel. But for those of you who've known me for the past 25 years that I've been in Singapore, I of course was on the sell side for the first 20 plus years of that, and now about 5 years at Singapore Management University. So just a quick quiz first before I get to your question, which is I'm the director of the Sim Kee Boon Institute for Financial Economics at SMU. Singaporeans in the room, do you know who Mr. Sim Kee Boon was?
Yes.
So in case you don't, we will be having a book, a biography launched about him next Friday. The foreword was written by the PM. We'll get some airtime at the Milken Summit a week before as the F1 is starting. We think it's a story worth telling. A bureaucrat, not a rich guy, not a politician, which is how you typically get your name on something at a university. Instead, when he passed away in 2007, Singapore rallied and raised a significant amount of money to endow at SMU this institute. Our mission is to bring academics and the financial sector together. And so we pivoted to this area of sustainability as one of our main focuses 3 or so years ago. And our job is really twofold. And it goes to this confusion that's out there. Jessica highlighted, we see our role as twofold: to be truth tellers and teachers. So to be honest brokers in terms of what is happening in these new developments, including in sustainability-linked products, and also to educate investors as these new products come out. So again, truth tellers and teachers. So again, as noted, I was on the sell side for 20 years, and I know from that experience that commercial imperatives might sometimes lead someone with a new product to maybe cut corners a little bit, to sell pretty hard something new that they have that they want to attract funds to. So the academics can play a role in this space by being truth tellers. Also, investors want to know about these new products, and so that role as being a teacher is our second big role. So we can start by the truth-telling side being skeptical. That's what academics do. All right, we don't believe you. We want to see proof. And we're going to take our time, unfortunately, in studying it. Sometimes the timeliness is a big problem, but to try to come up with an objective analysis about whether or not these products are really doing well as doing good, as everybody would very much like to believe, as one example of how academics have certainly gotten involved. You mentioned the specific area of ESG ratings, and of course we'll hear a lot more about that from Chitra. But I got to tell you, this is where the academics have sort of had a field day. It's been almost coming on to 3 years where it's just merciless. I mean, so in terms of probably the most cited paper, Berg et al., MIT group out of 2019, they clearly documented the inconsistency across the different ESG ratings, as well as the actual same ESG rating over time. All right, so a real skewering of whether or not you should be trusting these. I just flew in from the Global Research Alliance for Sustainable Finance and Investment conference in Zurich, which is the largest academic conference in this, and I just picked up 2 papers while I was there on ESG. I'll just cite them, ESG ratings. That one study showing that ESG ratings, using ESG ratings to divest your holdings actually hurts social welfare. And having a high ESG score is not necessarily telling to an institutional, telling to be an institutional investor leader. So again, truth is sometimes it's difficult, but you want that credibility. You want academics to be in there to say, really, is this, what's the problem here? Is this really what the bill of goods is being sold, especially in such an important and new area? So what we need is a call, for your input. As we are doing this, it can sometimes turn out maybe not the result you want, but you can bring us in. It's noted I'm the co-director of the Singapore Green Finance Center, and we've already have a lot of partners, many of whom are Endowus partners here on the board. I'll just go through the list of our founding partners: Bank of China, BNP Paribas, Fullerton Fund, Goldman Sachs, HSBC, Schroders, SMBC, Standard Chartered, and UBS, led by the MAS. For me, with my background in the private sector, I said we can't just have this be a university MAS-driven thing. We need your involvement. We need private sector involvement to guide academics as to the areas that we're doing. But that's, I think, our main role is to be truth tellers. I'll just say quickly on the second part, which is teaching, because as you've heard, investors, especially younger people, really want to know. But then, again, being a bit of a downer, do these guys know what they want and what they're getting into as they allocate funds into ESG space? So financial literacy in general, but then financial literacy on sustainable finance is an area that we're exploring very deeply. Endowus, together with some other partners, including the SGX, Lo Boon Chai is the chairman of my advisory board, and the Singapore government, Money Sense, which I don't know if any of you Singaporeans, again, actually used Money Sense. We basically found no one does. Very few people do. It's an incredible resource, but it hasn't really penetrated, especially young people. So we went and looked at these areas. Why isn't it happening? What do people, why aren't people getting up the curve if they say they want to know? What mistakes could they make? We did an SMU class, experiential class, getting students together with Endowus, together with MoneySense, together with SGX, Grab and C Group also were part of it, to hands-on try to get through this and so that we can get people up the curve and educated in this important area.
Thank you very much, Dave. I think you brought up some salient points around how it's still very early days, actually, in terms of the industry converging on a set of ratings and methodology in order to raise the credibility of ESG ratings. I know this is an expertise of Chitra, so I'm going to come to you, and I know that you've just landed this morning from New York, so thank you so much for joining us. From your global perspective, as kind of head of ESG, looking at APAC, and then also having links to the global markets, where do you see ESG going? And could you also comment perhaps a little bit about Dave's observations around the inconsistency of ESG data?
Oh, absolutely. So this is geographically, certainly, there's a lot of inconsistencies, as you can imagine. So firstly, just an introduction. My name's Chitra Hepburn, and I head up Asia Pacific ESG research and climate for MSCI. And what we do essentially is get all our data together to then create tools and analyses for investors to use different lenses. So ESG ratings happens to be one lens, and then we've got other lenses that look at climate tools, some of them forward-looking, and some of them just looking at status quo today. What does it look like in terms of greenhouse gas emissions? So briefly, for those that know, ESG is something that really took off in Europe a long time ago, way longer than in APAC. So they've had a head start, and they've put a lot of regulations in place. It's one, EU regulations impact all of the countries there, so it's a lot more easier to look at it as one change that they need to make across different jurisdictions. And I think we see the same thing in the US somehow. It's a little bit more homogenous if you take North America as one. What we have here in APAC is an extremely diverse and a very different sort of ESG profile, if you like, for every country that we see here. So if I were to just look at Japan or China, there's almost nothing in common in the way that they approach ESG or even climate. And it's the same to be said if you were to look at Australia or then here in Singapore, completely different. And this isn't just purely a matter of the countries then being at a certain stage economically to adopt ESG or to integrate ESG. I think it's also, for each one of them, the priorities are very, very different. And I think when you look at the energy mix across in China, and you've got quite a lot of fossil fuels there, Japan's had to contend with nuclear as being part of its energy mix. Then you go down further to Australia, and mining is a huge part of their economic base. And so you've got this very different mix of priorities across Asia Pacific. So leaving Europe aside, where they come up with quite a lot of regulations that work in Europe, I don't think they're easily transposable on the APAC economies. So what you do have here is some sort of an alliance to certain types of regulations. So you've got, for example, Hong Kong, Singapore, and Malaysia have chosen to go more TCFD based. If you look at Taiwan and Japan, then they're choosing to use more stewardship codes to guide where they go. And then Australia, where we've heard them talk about it a lot, they're only just starting to take action because their political climate changed very recently, and you've now got a party in charge that actually believes in all things ESG. In fact, the mandate of that entire election was based on ESG factors. So that's what you have geographically across what we're observing. From what we're hearing our clients tell us, then I would have to echo what Dave says. There needs to be a little bit more of a standard look at what this is and what it isn't. And I think part of it is also how ESG has evolved over all this time. And it started off as being a tool for basically investment professionals or institutional investors to then have a lens through which they could look at the resilience of companies when they looked at risks that were particularly sort of focused on the environment or social or governance. So it was less to do with impact as it started out. And as time goes on, now you're hearing more about impact investment, you're hearing more about, how does this there's a thing called double materiality that both of you know. And that's really looking not just at the resilience of these companies from a financial perspective, but then also looking at what is their overall impact from an environmental and social perspective. And those are quite different issues. And I think where we're coming to in Europe is a convergence of those issues and trying to look at double materiality as being one thing that we need to be able to look at. Now, because what you measure in ESG and climate are very different things, particularly when you're looking at the type of statistics. So I'd say on the E pillar, as you probably all know, greenhouse gas emissions, or you're looking at carbon footprint, these are more quantifiable, and they're easier for people to maybe put, on one level playing field. But when it comes to social aspects that Sylvia brought up, those are much harder to quantify. These are qualitative judgments. And again, they have a cultural nuance to it. What might be socially relevant in Japan is very, very different when you bring it down to, say, Indonesia or further down to Australia. So I think it's there where we have been working for 15 years to try and create a rules-based methodology. And what it does is it takes apart all of that data and it's only attributing it industry by industry. And that means we're not comparing a bank to a fossil fuel company, it's just within peers. So all banks, next to each other, juxtapose them and then figure out how they figure. Because we believe everyone's on a journey or some sort of a spectrum of adopting ESG or, for that matter, climate positive attributes. And so that's roughly where we see where things are. I could obviously go on forever about the differences in Asia Pacific, and I don't want to, but happy to take questions later if there are any.
Thank you so much, Chitra. I think you bring up some very, important points. And it's a good segue into the next question I have for all the panelists, and that's really kind of related to credibility and ESG data, and that is the big issue of greenwashing. The FT kind of published a opinion piece earlier this week called "The Future of ESG is at a Crossroads," and it talks about how there's a lot of skepticism around ESG because there's a camp that thinks that businesses should be solely existing to make profits, the Milton Friedman type of perspective. And then, of course, the other camp that believes that the role of business really is to enable societies, prosperous societies, that protects ecosystems, that protects the communities. And I think that ESG has had, a bad run, I think, in the press as well, because there have been many funds or money managers that have, put the ESG label on so many things. And today you see that you could have a high ESG score, like you mentioned, Dave, right? And you could be Exxon, and it's not very responsible for the environment. And you could have a low ESG score, and just basically not have any responsibility or not caring. For example, there's also a debate going on about how public listed companies are subject to a lot more compliance and disclosure rules. But then, once they divest, then the opaque private equity funds come in and they scoop up all these investments, and nobody has any idea what they're doing in terms of safety, of worker protection, of ecosystems protection. So, how are we to respond to something like that? I mean, it's a huge challenge for the industry.
I think, Jessica, you're right. That's a really delicate question. It's definitely require balance where companies are for profit and where is their social responsibility comes in. And that's an increasing questions we're asking the companies related to actually beyond ESGs, in really setting about double materiality, how important their impact is in the operation, throughout their operations to other stakeholders. So for example, there was a recent case we're looking at, Coca-Cola. So it's one of the most popular drinks in the world, but they are actually the top polluters in terms of the seashore waste. And the reason is because not of their own disposing the bottles, but it's people, consumers, finishing their bottle, but just dump it onto the seashore or polluting in the river and then just ended up in the seashore. But does it mean that Coca-Cola is not doing enough? Maybe. So what is the investor are trying to do is asking them, do you have any schemes to make sure your bottles are recyclable? Do you have any incentives to increase your consumers to do more actions on recycling your bottles after the end use? So it's a turn of the whole life cycles, of course, and you have to think far ahead, not just producing a product, selling across the world, but actually what ends up to your product at the end of the consumer, end of the product life.
Dave, Chitra?
I just wanted to add a little bit on perhaps what we're seeing as a trend right now, which is most of the regulators anywhere in the world are starting to step up in terms of requiring disclosure. Now, you brought up something saying public companies disclose a lot more than private ones do. And I would say, yes, that is wholly true when it comes to mandatory disclosures and what they're having to do. Where I think public companies are starting to step up, and I think previous panelists touched on that a little bit, is there's a lot more scrutiny in terms of consumers, and certainly in wealth, you've got a lot younger consumers who want to know, well, exactly where's my money going? Show me on a portfolio. And that could be green to brown, or it could be some other scale. But really that transparency, that increase in transparency that's required more and more is creating a space where it's harder to hide, and it's harder to pretend to be one thing when you're not. Because to your point, the FT did a piece now, but I'm very grateful actually to all of media that's been writing so much about ESG, whichever way it goes, because 5 years ago we just never got this amount of airtime, so it's all good. But I do feel that it's in its infancy. That's another thing I do need to draw out here. 10 years ago, not only was no one talking about it, there wasn't as much integration or adoption of ESG. So it's fairly young, it's new, requires a lot more thought and effort, and certainly requires it across the ecosystem, investors, academics, enablers like ourselves, and as well, MAS and others. All of that needs to come into play for greenwashing to then be a thing of the past. But the more everyone starts to request for a little bit more information and dig deeper, and also, as we mentioned earlier, there is a need to clarify what it is and what it isn't. So I would say that's really where we're at, growth phase.
Just picking up on the point on ESG being in its infancy, I think that ESG in the future, in the very near future, will become a hygiene factor. Actually, that you see all companies or financial products having that. And the gentleman before in the previous panel was saying that some clients have, they want ESG funds or non-ESG funds. I think in many minds, all funds have to have a certain hygiene, basic level of ESG. And then, of course, you have different extents of, where do you want the greatest impact? Is it climate? Is it oceans? Is it food? I think that variety is coming up. And I want to move to the
Maybe if I could just jump on just something about the infancy and trends, especially for firms. I think it's super important. Everybody knows how new this is. Again, I was on the sell side for 20 years up until 4 or so years ago, and definitely was not a thing. In Singapore, transformationally was National Day speech when PM, cited it as an existential threat, which, if you look up existential, if you don't know what that means, for Singapore, this place is its existence is at risk, and the raising of wanting Singapore to be a global green finance center shortly after that. That's when I raised my hand and said, let's be part of the academic side of that, and we got going. But all of this is new. Of course, Europe has been ahead, but I'll tell you, it doesn't take long to get up there. And we want the Asian, and that's where you need to play into it, because it can't all be driven out of Europe. It just isn't applicable in so many cases, as you just said. The Asian voice at the table is so critical as this develops. And I would say that as this develops, so we talk about how people are being careful, wondering about what their role is. Well, you can do this 2 ways. You can say, hey, there's backlash, and it's happening, right? The ESG backlash is happening. We see that politicization, especially in the US. And you can say, you know what, I think that's it. I think it's going to roll back. And there are anti-ESG funds that are developing. People are getting as dirty as they can and showing returns. All right, you could go that way. Or you can do the opposite, and you can jump to the end and be a leader. And that's where kind of this niddling academic saying, oh, the ratings aren't so great. So what, right? We're building something. And so where will it head? And the word impact has been brought up. And it's a very broad word, right? So we're not going to, I think the idea of impact assessment broadly, positive and negative. You're going to look at a company and say, yeah, you pollute. Negative. Are there other things that you're doing that should be on this, especially on the social side, or other things that people are doing, carbon capture, all the rest of it that can be positive on the E side? And it's really hard, but you might as well get there because your stakeholders are going to be pushing you in the future, and that's the feedback you should be getting ahead of, and you should be telling your companies. It's tough because you got to monetize that. You got to put a dollar figure on it so you can compare across these impacts. But that's something that we're working on together with the Impact Institute in the Netherlands, together with Harvard Business School. We think people might as well jump to the end and don't fight it. Be a leader, especially out here in Asia.
Yes, I think you brought up some great points here. And one of the things that I say often to the boards I speak to is that expect that you're being scrutinized and ranked, whether you like it or not. You know, that's not a choice anymore. And I think for the public listed companies that the pressure is greater. And if you're not thinking about disclosing to the TCFD or disclosing your Scope 1, Scope 2, Scope 3 emissions, then you're very, very far behind the curve. I want to move the conversation a little to the retail investor. We've had a few interesting questions here from them. And I'd like to, put a shout out to Endowus. I know Sam's not here and he didn't ask me to say this, but when they first launched, I was really impressed that you were able to go on the platform and actually, as a retail investor, invest into ESG funds. And, just a few years ago, 3 years ago, I asked my relationship manager, I won't say which bank, whether I have some, sustainable products. And I got like this blank look. And then I had to explain to them what a sustainable or ESG fund was. And then they said, no, there's nothing available. It's obviously different today. But in terms of the access that retail investors get to, ESG funds or impact-related products, where if they want their money to go further, and Patricia had mentioned earlier, about women investors, younger investors being more curious. And I also want to steal a phrase from her. She talked about crypto and how family offices and investors are crypto curious and not crypto committed. The same can be said for ESG investing, I think, or impact investing. And how can we move the needle then? And I'm going to combine a couple of questions here. One question from an Endowus investor here is, I'm interested in ESG related investments, but what is the difference between an ESG ETF, ESG index, and ESG fund? As a new investor, what would you recommend? And then a related question to that, I think, is what is the biggest obstacle to ESG investing? Will we see this become a 100 trillion asset class?
Maybe we ask the investor to answer the investor question.
We definitely love to see that's becoming a 1 trillion asset class. But in reality, I think what an investor need to ask is, what is their ESG objective? What's the definition about ESG? We need to talk about the same ESG we're talking about. From the product perspective, what they're selling, does it mirror to what you believed in? Is it what you want to do? Is it the social causes, or whether it's environment, whether you're interested in circular economies or biodiversities? And to look at how can you measure this besides the financial returns? Many times, financial returns may be volatile, but we need to look at the real world impacts that really matters to you, what you feel most materials. And talk to your financial advisor.
I'll just add one more thing to that. This is not a short-term punter's market. So you're really looking at change that's going to be in the mid to long term. And everything you're trying to do is actually trying to impact an industry positively, if you can, through that mid to long term lens. And so I think it takes a little bit of patience, and it takes a little bit of education, where Dave comes in. What to choose. And you mentioned that earlier, that they don't quite know, as new products come out, what should I actually be picking. But then, to Sylvia's point, the objectives that you want to achieve. And then what many investors are choosing to do, particularly in wealth and younger investors, they're looking at a very specific kind of impact. So if they feel that they have a pet cause that they want to invest in, and I think Pat brought that up earlier, that women tend to have that laser focus on what they want to have an impact on. I think if you put all of that together, that's sort of a kind of guidance, but certainly we all need help, and whether you go to academics or a financial advisor, one hopes that today there's a lot more choice and people are actually able to offer that choice to you. And if it's not there, then guaranteed in 6 months there will be, because there's been so much talk around it. So I'm pretty sure it's going to be top of the agenda.
Yeah, thank you so much for that layup for me. And I mean, in terms of retail, it's all about education. Again, this academic conference I just came from studied ESG funds and fees. topic was brought up in the last panel. And guess what was the highest explanatory variable for willingness to pay higher fees? Lower financial literacy. Right? And so I think it is all about educating those retail investors to just in the broad sense, but also on the specific desire, because we know the desire is there, but we just need to make sure they know what they're doing, and that'll make for a better environment for all of us.
Thank you. And a bit of a plug here, but for the investor who asked about the difference between the ESG products, if you sign up to the Eco Business newsletter and look at our news website, you'll find all the answers there. If I can move on to the next question, really, and I think this is a question for Amundi and MSCI, for Sylvia and Chitra. We've seen the market kind of being a really volatile situation, and there's a lot of macroeconomic forces, including the Russia-Ukraine war. There's a question here around whether you have seen lower interest in ESG products and indices because of the underperformance of these funds. And then a related question to that really is that as the global economy continues to grapple with the war and energy prices keep increasing, how is this going to impact ESG funds?
Okay, so that's two questions.
Yeah, sorry.
To depart, and then I'm looking forward to anything you can add on to it as well, Sylvia. So on the first, have we seen a drop in interest? I think it's been quite, without ruffling any feathers here, it's been quite geographically pronounced, that loss in interest, if I can say that. So across the pond, a lot more. But I think not in Europe so much. And here in APAC, I think there's a lot more opportunity that people can see because it's a growth region. So you still have a lot of funds that are doing the right thing, but also able to still show some growth. So I think it really depends on where you are. The energy crisis, I can't downplay this. It's had a huge, huge impact on how people are looking at energy mix. I met a fund manager the other day who called his fund a transition fund. That's about anything, right? A catch-all for you can move between fossil fuels and renewables at will, and be at any sort of stage of transition, if you like, even going backwards. So I think there is that where people are trying to exercise a certain amount of flexibility. But I think if you're looking at the longer term and you're looking at where we will be in 20, 30 years' time, if you look at the graph of what any of the forward-looking projections show, you're going to have to move into a renewable transition economy just because we're going to run out of all other options. So I think if, again, coming to the mid to long-term view, that is the future. How soon people choose to embrace that and say, I'm on, it's something like what Dave was saying. You could step off and say it's not happening, but that would just be, sticking your head in the sand. I think it is happening for sure. Question is, when do you want to jump on board?
Yeah,
Any perspectives?
adding that, I think last year, November, COP26, you see growing momentum of net zero ambitions that was set out. We haven't seen any nations have been backing down on any of their commitments. Albeit some of them are reverting back to fossil fuel as temporary responses. But I think in the long term, mid to long term commitment base, there's currently no backing down on that, which is great. Of course, depending on how the situation goes, pan out, but many of the alternative solutions are becoming more real. Be it the nuclear options or hydrogens may be more feasible as well, not alone the renewable energy in terms of to ramp up as much as possible. Of course, it requires some time in terms of productions for some of those projects, and the near winter is just approaching, and it's one of the emergency, of course, in the meantime. But other than that, I think all other investments need to still step up on the clean solution part.
Thank you very much.
Yeah, I would just say, I've been in the markets now in Singapore for 25 years, and I've seen things come and go, and I keep wondering, oh my gosh, is that it? Are we going to stop this? Yeah. And for those of you who haven't read this, or go back and read, SM Tharman's brilliant, speech back at the IMAS conference back in March, the long, perfect, storm, a couple of weeks after the Ukraine invasion. And among what his point is, it's a long, perfect storm because these things are not cyclical cyclical. They're not one-off. It's not a convergence of coincidence. These are structural things, and the sustainability trend is one of those. And so it's not going to go away despite all of the, instead you're going to see accelerations. The European winter, I think you're going to see that pivot, and you saw Secretary Yellen's speeches here where, the U.S. is behind, and they're going to double down in terms of alternatives and other things to move forward. So I do think it's safe to say that this will keep going, and the best thing to do is to get ahead of it. I don't hope, if you are been resistant to it, embrace it and try and push to be a leader.
Well, I have you here, Dave. I'm going to just take one last question from the audience, and that is actually a question around, the point you made around financial literacy, which is that if you were a retail investor, what factors should you be considering when you look at ESG funds, and whether they have quantifiable commitments to its sustainability and not just lip service?
Wow, it's so hard, I would say, right now, given the options that are available for a retail investor to know. I think the ratings are still the most valuable input that you can have on that, despite all the academic skepticism. There are a range of those, so I would pull all of those ratings in as your entry point to try as a retail investor to navigate. But things are evolving. And I would say that reputation, as was said before, this is so critical. And the calling out of funds, the greenwashing accusations are, I think, important. You're going to see people, hopefully, be more careful, and there be some consequences, I think, for those funds. So as a retail investor, I think you should pay attention to those too.
Thank you. Very well put. I think, wrapping up this panel with my last fire round question, what is the one thing that you'd like to see happen in the next year, which you think would make a meaningful difference to ESG investing? Silva, I'll start with you.
Really greater standardizations of the ESG definitions that we're talking about.
Greater standardization.
I would say that my first job was, I spent a lot of time in the private sector. My first job, though, was at the central bank in the U.S. and the Federal Reserve, and we need the sovereigns to lead even more. And because we all know about the country level commitments, but regulatory moves everything. And so we've seen that happen in Singapore at a minimum, them pushing on risk, stress testing, all of that stuff, and we don't see yet enough of that happen in other geographies. So I think that, as well as, by the way, allocating some of your sovereign wealth into this area, which is also still at emerging stages. So I'd like to see governments step up even more.
Yeah, on that point, actually, I think GIC and Temasek has done quite a good job of allocating the investments into sustainability-driven thesis. So thank you for raising that point. Chitra?
I'd like to add to both, actually. So yes, standardization, a common language, definitions that help us, speak to each other in exactly the same way and understand what we're talking about. But the second part of it would be, as a follow-on, the disclosure. So when that disclosure rate gets to a stage where you've got enough data that you can rely on, it becomes a space where you're less skeptical because you've actually got the data to back it up. And I think people can see that transparently. That's sort of been our onus, has been on getting enough transparency in the market. So, yeah.
Thank you very much. And I think for me, the response really would be knowledge and education, because I think that it all starts with knowing your environment and knowing what's affecting all of us, and then allocating that dollar that you own in the most responsible manner. So thank you so much for all those insights. Thank you, speakers. Please join me to thank them for a really insightful discussion. Thank you, Jessica.
Definitely a really interesting panel. Jessica and I have actually known each other for a very long time. We started out reporting around the same time. And I remember in 2006, one of my editors said to me when I launched my first sustainability segment, nobody really cares about any of this fluffy stuff. So how times have changed. ESG, you can't go a day without some kind of press release related to sustainability and ESG. I think just this morning, SGX and MAS have announced that they've launched a web tool to help companies auto-generate ESG reports as well. So a lot to digest there, a lot of climate confusion still for investors. So for our next panel, we're going to move from sustainability to sustaining scale, okay? So in Singapore, we've spoken about the size and the growth of the wealth tech industry. It's a multi-billion-dollar industry with both investors and entrepreneurs rushing into the space in hopes of disrupting and creating value in an otherwise traditional industry. So how can those entering the scene stand out from the crowd and carve out a niche and serve real market needs? We're going to find out. I'd like to invite to the stage our next panel, moderated by Gregory Van, CEO of Endowus. We also have our speakers, Oi Yi Chu, who is the CEO of ADEX, Deepak Khanna, who is the head of wealth and trading at Revolut, Varun Mittal, Chief Growth Officer and Group Head of Digital Singlife with Aviva, and David Grant, co-founder and COO of GoTrade. They're going to be discussing from founding to scaling, where are wealth tech firms headed?
Thanks so much. Obviously, wealth tech firms are headed upward, right? That's the, no, thank you so much for all being here. We realized, and we did this on purpose, that we gave you no bathroom breaks and no coffee breaks, because if you left, it'd be very hard to come back. There's a mob scene outside. You should, but if you need to get up and go to the bathroom and come back, we won't be offended. Feel free to do so. Tell other people outside to come in at the same time. Really quickly, exciting topic, great panelists. You know, Singapore is very warm, right? Because it's on the equator. And the equator is really, you know, the center of the earth. You know, and Singapore is in such a unique position to lead wealth tech, to lead fintech into the future. I mean, it's a great country, great rule of law, tax incentives, and has become more and more of a wealth management center for not just Asia, but for the world. The second biggest inbound wealth hub in the world, fastest growing wealth region in the world. Really excited to be here. Really quick, 2 sentences each on what you do, what your firms do in the wealth tech space as an introduction. Go ahead, Varun.
I run digital for Singlife with Aviva. It's an insurance company which also owns Navigator and Dollardex. And we have a CASA account equivalent which gives interest. And I run that business.
Oi.
Hi, I'm Oi. I'm the CEO of ADEX. ADEX is a private market securities exchange headquartered here in Singapore. We're running on blockchain technology, so we can, of course, spend some time on that as well.
Hi, I'm David. I'm the co-founder of GoTrade. We offer fractional share trading to retail investors.
Hi, I'm Deepak Khanna. I head wealth and trading for Revolut in Singapore. Revolut has been synonymous with payments, FX, remittance services, but of late we've been getting into wealth services where I come in. So things like commodity trading, we went live with earlier this year, DPT, which we went live with earlier about a month back, and stock trading, which is coming soon in Singapore.
Cool. So, you know, this panel is about sustainable scale. Tons of money has flown into wealth tech. We've seen actually some firms rise up and fall very quickly. There seems to be many different approaches to serving the wealth tech industry. What do you think the market is oversaturated? I mean, I go on the street and I see not just Endowus ads, but a lot of different ads pushing different, you know, ideas or products, telling me to buy different things. So, do you think it's oversaturated?
See, all non-bank wealth platforms combined in Singapore are less than $40 billion AUM in a market which is $2 trillion AUM. Overall, globally, if you look at the $2 trillion of wealth which sits in Singapore from other countries as well. If you're looking at $30, $40 billion as a percentage of $2 billion, there is a massive scale left. And we haven't even looked at where working capital management solution, treasury solution starts to come in. It is just scratching the surface yet. Of course, there are segments where probably there is saturation because everybody is trying to target the 18 or 20 to 40 segment, which has a decent income and is able to digitally self-serve. There is probably, I would say, a higher level of saturation in that segment. But overall, from a market opportunity perspective, it's too early.
Too early. Okay. I mean, we are early in that evolution. Does anyone else want to comment on that oversaturation? Go ahead.
Well, I'll just make an observation here, right? Many of us, actually even around this 5 of us, come from traditional banks, right? There's one piece that is, why are traditional bankers leaving banking to start up WealthTech or fintechs? It really, a lot of that is the frustration with the existing incumbent infrastructure, which has become too expensive to maintain well and to catch up with times. And there's a lot of regulation that have changed, and the tech and the ops are actually not coping with that. So many of traditional bankers are coming out and saying, how do I solve this problem? That's one piece of it. So it's an efficiency problem. But second is also the way the markets are shifting. There are actually a lot of opportunities to capture space that hasn't been captured. I mean, for example, private markets. You heard from Edmund earlier from Apollo, which is, it's currently zero exposure to retail and high net worth, or pretty much a very, very low percentage. So there's sort of 2 big opportunity sets that's creating a lot of startups. I think the question is whether it's saturated. I think there's some ways to go.
Okay. I'm going to skip the script here and jump to Deepak because it's sort of a segue to what Oyi was saying. Despite the stiff competition from neobanks, Revolut has positioned itself as a market leader, offering a wide range of services. So how can WealthTech scale while remaining nimble enough to adapt in today's rapidly evolving market? Does every WealthTech need to tackle multiple verticals? I mean, should we specialize? Should we go broad? Revolut obviously has a whole host of services, different services all around the world. What is the strategy?
Yeah, so if I were to talk about the Revolut strategy, it's about being a financial super app. So we want to do all things money for customers, and we have a very wide range of customers that we are interested in. We believe that a customer should not be having 5 or 7 different apps, one for, let's say, payment, one for FX, one for stock trading, etc. So it's all in one place from a customer perspective. So we build those products that I just spoke about over the years. But we're also catering to different client segments. So we got beginners, we got experienced customers, we got individuals, we got business clients as well. We're also getting into services which are not traditional financials, like donations. So things that you don't associate with investment, etc. But if you believe in a cause and you want to donate money for somebody, you could use a Revolut app for that. You could also manage your children's financial services through an under 18 account as well. Now we're branching out into the wealth and trading services. So our strategy is about having multiple products rather than being a niche silo single product owner. And that's worked well for us. From a very small business about 7 years back, now we're talking to about 20 million customers globally. We got 800,000 customers on the business side, and that's sort of working for us. How we do it, I think we just want to keep things 10x better. So whenever we get something into the market, we want to say that it is 10x more simpler, 10x more useful for a client, 10x more rewarding, and that's what we feel that adoptability and attraction is quite high. I think just on the first question that you asked, I feel that the market is not saturated. There's a long way to go. Market share is one of the aspects to look at it. But I think there's also a segment of client which is likely to come on the platform, like I just spoke about, which is multi-product, which are underserved clients. And I'm not saying underbanked, but underserved, which means that you did not have access to advisory or stock trading because the amount of money required to start the service is very high. The fees were very high or were not transparent, or you didn't have the trust factor. So those are the things that come in if you're a multi-product rather than a single product silo. That's what we feel.
Okay. David, I'm sure GoTrade probably has a slightly different strategy here. I mean, you guys have gone super broad, a lot of countries, tons of users, and you can quote some of those numbers if you like to give people a sense of that at scale. What is the strategy there?
Yeah, so for us it was very much around financial inclusion. So very much the point you were making earlier is there are a number of people. We believe the total addressable market is probably about 270 million people. And so what we want to do is we wanted to occupy a space which allowed investors to come onto a platform for the very first time. So the proposition that we offer is you can trade from as little as $1. So the products that you're interacting with on a daily basis, like Apple, like Microsoft, and obviously Tesla, and all these other names that you encounter all the time, you now can gain access and ownership of those particular names from as little as $10. And I think that's, or even $1, I beg your pardon. So that has really resonated with people. It's given them a real true on-ramp into capital markets for the very first time. And so our focus is very much going into markets and looking into markets where that accessibility is not available today. It is a very, very high barrier to entry, and so we want to occupy that space. So to the point that Oyi was making, born out of frustration is why you end up looking at some of these different solutions. And so one of our co-founders was trying to access the US markets and couldn't, and therefore we decided to go out and build this thing ourselves. So luckily fractional was coming live at the time, and so we were able to be able to bring that to a wide range of people. So yeah, the numbers are pretty phenomenal, and it really speaks to how much of a need there really was.
Okay, and then a question from our viewers, actually, which follows up very well on what you guys were just saying. The benefits of being a super app for wealth and finance over offering a single specialized offering. I think we've all of us have approached this differently in our firms. Endowus very focused on being fee-only, digital-first wealth manager. Localizing CPF, SRS, and cash savings. Singlife Aviva, huge existing business, digitizing, et cetera. Super app focused on trading, tokenization of alts and private markets. So what do you guys think? Do you think specialization?
Not trying to time the market is what we would say.
Yeah.
So, for example, we own 2 brokerage firms which actually sell other insurance products also, not just our products. So if there is other product which is better for you, we will sell that, and it's fine. So what our view is that we can never have the best product shelf for everything possible. No matter what we do, we can never be the best for everything. And that's something which we've acknowledged. And which is why we enable those parts of our business. So we believe that there are parts of things for which customer would want an advice, but there are things they would not want an advice. For example, for your travel insurance, you would not want an advice. For a gadget insurance, you would not want to sit with somebody to discuss. Mm-hmm. But when you're planning something which is a 55-year, 70-year commitment for your family about protecting them for their old age and everything, you probably would want an engagement. You may want to do it digitally on a tablet per se, but you may not want to do it alone, on your own. So what we believe that for every individual, there will be a spectrum of needs of a customer. Some will be DIY, some will be with, I would say, assisted mode, some would be advisor-led. And we have enabled all of them to let the customer decide from that perspective, because the customer preference, COVID happened, nobody could predict. Mm-hmm. COVID significantly impacted the customer's preferences. A lot of customers who would not do a digital KYC on their own before would now do it. A number of customers who would do SingPass KYC before COVID and now. Number of customers who would do Pay Now top-up before COVID and now. It's drastically changed.
Yeah, I barely knew what a QR code was in 2018. So.
Premise is, if we cannot have a crystal gaze for 15, 20 years down the line of what all COVID 2, COVID 3, or similar things could happen, there is no, we would not want to time them. We would not want to time it. We would want to position it that yes, we have all of these, and if, for example, it moves a lot more DIY, we're there. But if some products become more complex, because now customers want to live longer, they're living longer, so their definition of retirement and critical illness solutions have changed. So if that moves a lot more towards human, we have a solution for that. So what we would look at is, we would want to be the best shelf possible, mm-hmm. in whichever mode you would want to consume. And we believe as gig economy moves, so like your traditional retirement, CPF is no more relevant. So that will change. We cannot time exactly which way it will change. Mm-hmm. Will it move towards Nordic? where there are government pension and private pension? Or will it be a lot more American, where it's like people do it only and the government will totally step out of it? Or there will be a new Asian model? We don't know. We will position the platform to be able to handle the way it changes. So we would not pick, we have probably a third approach. Not try to do everything the best, not try to be a financial super app.
Right.
You know what you're best at, and you know what all stuff you need to enable, and then drive along as the market evolves.
It's an interesting perspective because you guys, you have a very large incumbent business, whereas a lot of us, are building a business from, a zero, basically. So, Oi, what's your view on this in terms of, being attractive by specializing or broadening?
Yeah, I think that's a very interesting question. The way that sort of I think about our business, it's actually a combination of competencies we've had to build, right? It's about the technological capability combined with the legal and regulatory aspects. And of course, the commercial innovation has to come alongside that. And I think about, we specialize in alternatives partly because we think our technology can solve a lot of the issuing and post-trade pains that financial institutions and individuals have faced along the whole alternatives universe. But even within that universe, it's actually quite wide, right? From credit to funds and things like that. I think it will be a function of focusing on our strengths, where that might lie, and building the partnerships and the relationships that go with that to create that scale. And I don't think anyone really has the perfect answer. I think some people will do well, very specialized. Maybe the tech is not is particularly focused on, for example, credit, or a business in particular has a strength in high net worth individuals. So I think it kind of depends on the company itself and the strengths and the competencies it's building upon.
Okay. Yeah, and if I could just add to that, I think it also depends on what problems you're trying to solve, right? So I think you've got to start somewhere. Not all firms are massively capitalized that they can go out and do all these things. And so you've got to start somewhere, and you start off by what problems are you trying to solve, and then from there you build a business from that. And so I think everyone's journey probably looks a little similar to that. There might be aspirations for a much bigger business later on, but frankly, you've got to start somewhere. And I think if you start with that notion of what problem am I solving and occupy that space and do it really well, you have a foundation on which to build a bigger business, if that is in fact your desire.
I think being broad doesn't mean you're not specialized. Yes, you may not be the best player in the market across every feature of that product. And definitely, we probably will not be able to compete, whether it is some of the pricing, some of the incentives sort of being sent in the market right now. But I feel that given the fact that you're talking about wealth here, which is a highly regulated market, you need to have those protections, those specializations, which are the minimum standards. But of course, be meaningful to a client. My sense is that Revolut built about 20 million customers right now, which some of the traditional players took like 40, 50, 70, 100 years. And that's because the definition of brand and trust is changing. And that's where probably specialization can be attuned to. It is no longer about how big your balance sheet is or what your pedigree is. It is about whether the product works. Does my app work? If I want to call somebody, or if I want to chat with somebody, I want resolution to my problem, do I get an instant response, or I have to wait 4 days before I can do something? So as long as the product is working for a client in terms of the feature, which is more meaningful to the broad base we're talking about, I think that's what you're looking at. And to me, that's specialization. But yeah, I'm not talking about every aspect. Of course, we can't compete on that. But you're not diluting specialization just because you're more broad-based.
Okay, interesting. So just painting a picture of the future here. Let's say 10 years from now, do you expect people to use multiple digital financial services, or to sort of centralize that in some way? I mean, it could be the case that the super app also partners with other players to centralize everything. I know we talked about the digital banks perhaps taking on such a strategy as they enter Singapore. We're seeing it happen with virtual banks all around the world. Do you see people wanting to consolidate or wanting to spread out? I mean, from what I've seen in the past is people typically, well, depending on the segment of the market, would have multiple bank accounts. And I mean, it's inconvenient to have multiple bank accounts, but they do it because there's a perception or maybe a reality that it is it is safer? Where are we headed in this digital experience?
Historically, the market has always moved from the great bundling and unbundling.
Correct, and then
first generation
keeps on going in and out.
You had the MSN portal and Yahoo portal generation. Then it all went away. Then then everybody wanted to specialize, and now it's like kind of coming back where Facebook is saying, okay, I will have like a consolidated identity across my platforms, and I will try to unify them, while the people who are branching out. So let's say a Snap or a TikTok would say we want to have one thing only. So that bundling goes on. But in financial services, I would believe regulations will play a lot more important role. In Europe, for example, where open banking and mandatory API access is there, so you are regulatory required data to open it in a much more structured way, you would see a lot more aggregation happen, because a new challenger could build something to be able to build on top of others.
Yep.
However, when you look at, let's say, Asia or US, the open banking, most cases there are no laws. And even if there are, they're not the European level. So in Singapore, you can't build an aggregated app per se. Non-FIs are not even allowed to enter SG Findex yet. And SG Findex also gives you like data once a month.
Correct. Yeah.
And each FI you want to onboard, you have to add them one by one. So it's not like one click you pull all. So that's very different from, let's say, Europe. So I believe at least in Asia and US, you would still have multiple players. However, in Europe, you may have a scenario where people have one, where the manufacturer and providers may be separate, but interface access becomes unified. But in Asia, the interface access will remain separate.
Do you think regulation will play a big role?
I would say that regulation will be the deciding factor in this, from that perspective, because does your access interface become standardized or not? That's something which is beyond market forces.
Yep.
And because Europe has taken a position that they will mandatorily regulate it, while US and Asia have taken a position that they would not mandatorily regulate it. So you have two diametric poles already. So that means regulations define it.
Okay. What do you think? Do you think people will have specialized alternatives, digital, other things?
I think people will still want choice. And if you think about bank accounts, it's likely that whether it's on the investing side, we'll likely have more than one. The question is more than one what? Is it an app, or are you still talking about a traditional advisory relationship with the bank? So I suspect it's going to become a discussion around what is the mix between that two, rather than have a consolidation of investing apps to a single source. I think alts presents a very interesting solution, partly because it's a growing space, but I think it will start to converge between traditional public equities and bonds and alternatives at some point, whether that's in a place of a super app or in the place of an aggregated, platform. I think that remains to be seen. I think the bigger question is more what's the mix between what we call offline and online, and I think that dynamic will continue to shift. Consumers who want to hear a friendly voice over the phone, or it wants to compete on prices, can always then go back to the advisor and say, it's cheaper this side. So that's a dynamic I think we should be watching out for.
Okay. Any other comments? We can.
Yeah. Go. Okay. Let's give an example. So my daughter's playing games. She's done well in one particular game, reached level 7, got some assets she's acquired there. She goes to the next game, she has to start from level 0. So whatever she has built in terms of her value there has got no significance on the second app. So I think the portability between apps is very important. You take the financial industry, if I want to buy a US stock, I have to have an account in one app or one bank. I have to then move money for which I'm using some other player, a second app. I have to do FX because the US trading person is not doing FX. I have to do a third app for that. And then finally, I do a US stock trading fourth app. The time I'm spending between these 4 transactions, between 4 apps, and the cost I'm spending is humongous. So if somebody could consolidate that for me to instantly purchase a US stock when I want to do it, of course, the pricing will not be as good as single app, but over the 4 apps that you're using, the time and cost you're spending, the value that's coming to the client is far more. So of course, there will be choice. Don't deny that. But in terms of convenience factor, the more you're portable across different apps and consolidating into a single app, probably has more value compared to having 4 or 5 different apps at any point in time.
Yeah, that's exactly the point I was going to make around a frictionless experience. So to the extent that people are looking, you want to meet your customers where they are. So we, for example, have started with one product. We've solved some of those problems, fortunately, already in terms of trying to move the money around, born out of a very frustration that you talk about. And so there are a few things that we've kind of done, at least to try and mitigate some of those frustrations. But I think as we look at how our customers grow, and I was saying just before we came onto the stage, about 18% of our customers have never traded before. So we have a US-only product, but 18% of them have never traded. Not never traded US, just never traded at all. And so that's kind of their starting journey. And so we got to work with those guys to see where are they going to go, what's their evolution, and how can we meet those needs from an ongoing perspective. The other one is obviously consolidation. And so we see this across the industry all the time, that the easiest way is either build or buy. And so what often people do is they'll go make an acquisition to plug a gap that they don't perhaps have today, or they have today, I beg your pardon. So I think there's some of those shifting sands that are always happening. But I mean, obviously in 10 years' time, it's going to be hard to say, but I think that's kind of where we've always moved, is that aggregation and consolidation within the space as people are making acquisitions to plug gaps that they have, and then also the customers growing up and becoming more sophisticated and looking for those solutions. So whether they find them with you or someone else, I think that choice element is still going to be there.
Okay. You know, there's tons of data. We've talked about big numbers, $2 trillion, fastest growing country in Asia for inbound wealth and things like that. But honestly, a very small amount of AUM that has gone digital. What is stopping people? What is stopping the market from moving?
So I usually have an empirical test that if the weekly drawdown on your portfolio is more than 2x your monthly income, weekly drawdown on your portfolio is 2x of your monthly income.
Okay.
That time you need somebody to hold your hand to tell you it's going to be okay.
I see.
And so premise is, as people's wealth starts to grow, even a 3% drawdown in a week starts to be 2x of their, because the wealth compounds faster than their personal income growth from that perspective. So when people start to hit that, and in Singapore, the moment your AUM is somewhere between 250 to 500K, that time a weekly drawdown can start to go 2x of your monthly salary in terms of weekly, and that is an empirical point at which you need a human, because that time an email message from the CIO of the digital platform does not calm you down.
You must not be a very good investor, Varun, if you get so nervous so easily.
No, so the premise is, for an average person on the street, the premise is, has your need become complex, or the volatility has become too much, because you stop seeing it as in percentages. You start to see it in absolutes, which is why I said the exact drawdown is 2x of your monthly income, that the dollar amount starts to make you nervous.
Okay.
So that's when a human touch becomes more valuable.
Okay, so you think this is one of the inhibitors of more wealth digitizing at a faster rate?
I would say that's one part, and what that becomes is a trigger when the digital platforms acknowledge that there is a part which will be in a DIY, and there will be part which will be human managed, and there will be a hybrid beyond a point. So the number of customers who will be, let's say, $3 million AUM and pure digital would be very less, versus they're having 2.5 million being managed where a human is involved, and about 300-400 they're doing on their own kind of thing.
Okay.
So some kind of that balance, if digital platform starts to look at that, people would not want either or. They would want a mix of both. That, I believe, would start to open up market further.
It's a good thing Endowus is a mix of both, so that's great. Sorry. What do you think?
I think Asia, I mean, if I just, somebody compared this for me, not a quote from myself per se, but Asia has a few dynamics that are sort of makes it a very young investing population. So first of all, I think Asians tend to be, they tend to be traders, right? They like the stock market, well, until maybe sort of this year. but they kind of like to play single stocks. They hear from friends. They kind of do this, do that. So that there's a bit of that wealth planning, wealth thinking is not as well developed as it is in the West. So I think a lot of it is going to be about education. A lot of it is going to be understanding what tools are available to them to look across asset classes and build their own portfolio that sort of meets their own life cycles. The second thing is there's also, a very big private banking or space where there's still reliance on advice as well. But the more that digital platforms, I think, present education opportunities and help the younger generation who are generally more digitally savvy and generally would sort of read up and do it on their own, I think the more that you will see digital adoption taking up in more rapid style.
Okay. Interesting. Anything to add? No? Good?
I think for me it's the adoption curve, right? So cars did not go driverless overnight. There was cruise control, there was power steering, there is gearless cars, and of course now we're still getting there. Banking, financial services will not go driverless immediately. It's going to take some time. I'm liking the word hybrid, which means the tilt is 50-50. Just about 2 or 3 years back, I believe, I could be wrong, but I believe the percentage of online stock trades in Singapore overtook the manned trades only about 3-4 years back. Okay. So trades were still happening through phones, through remisers, through wealth managers, broadly speaking. And when online took it over at about 3-4 years back, I'm happy that advisory sort of had a hybrid level. I'm hoping that the percentage is going to tilt more and more toward the digital side because there is a clear advantage of digital to take out bias. One of the main problems with humans is that we're not rational. We have that emotional curve, and we end up buying things when they're rising. We end up selling things because of fear when they're falling. We should be doing the opposite. Robo-advisory is a classic example which resets that. So as an asset class outgrows because of outperformance, you sell it and you buy something which is underperforming on a relative terms, and therefore you're rebalancing the bias that you may have. And those are the things and differentiation which need to come in to really bring the adoption ahead. Right now, I feel the differentiation in the industry is largely around cost or some interesting platform, easy to use. But once all these other USPs will start to come in, I think that's where the adoption curve will continue to grow. But again, we are at a very early stage, at least in Singapore, Asia. We're at a very early stage right now, and there is a long way to go.
Okay, wonderful. Thank you, everyone. That's all we have time for. Very insightful. Yeah, moving on to the next panel.
Thank you.
Thank you.
Definitely a lot to digest there in terms of what you're offering to your clients, a buffet, or are you going to be more curated? Coming up next, we are going to be discussing rethinking the role of financial institutions, and that's a theme that we've seen throughout today's panels and sessions, and I think a key point that we've seen echoed as well is how do we couple trust, touch points, and technologies. So if you've followed the world of NFTs, blockchain, or cryptocurrencies, even a little bit, you've probably heard of DeFi, and it stands for decentralized finance. Millions of users are discovering digital assets every single day, and they want to find out how they can perhaps make these digital assets, help them to make their money work a little bit harder for them. To help us uncover DeFi and new gen investing, we are going to be joined by Kay Van Peterson, who is the co-founder of Decentral, Anton Rudenklau, who is partner and global head of fintech at KPMG International, Catherine Ng, managing director, TZ APAC, Gerald Goh, co-founder and CEO Singapore at Synagem, and Jeremy Ng, who is the co-founder of Open Eden. Let's give them a warm round of applause and welcome them to the stage.
Putnam Bank. Okay, cool. Sorry.
All right, ladies and gentlemen. First of all, to the audience, both physically as well as digitally, appreciate you all making the time for, I'm sure, what is going to be the most riveting segment of this WealthTech conference as a whole. There's a lot of interesting developments that obviously happened in the crypto, blockchain space, let alone DeFi. As someone who's been covering the space and been invested initially since 2013, it's pretty mind-blowing to see the progress, as well as obviously lack of, which I'm sure we'll be touching on this panel. I think we should also give a shout out to Endowus. It's good to see a Singaporean wealth tech champion carving up over $2 billion. I don't know about you, but it kind of gets a little bit annoying to keep seeing US VCs getting all the highlights. So good to see some homegrown talent taking it as a whole. So my initial thoughts were to at least start with a definition of DeFi, because before you can really talk about something, I think it's important to at least know some parameters and frameworks kind of around it. And it took me quite a while to put something together, but I thought what was actually better was to pass it to our esteemed panelists here as a whole. So we're going to do a few kind of quick introductions. I'll let them speak, giving some context to themselves, some of the firms that they've maybe worked at, and obviously who they represent today up here. We'll then have a few direct questions to each and one of them, and then we'll open up for a little bit of each one of them to be able to kind of kick in. And then, of course, we got a whole bunch of questions from the audience as a whole. So with that, why don't we start at the top end with some intros, please.
Thanks so much. Hi there, my name is Gerald. I'm a co-founder and the CEO of Singapore for Signum Group. Signum is the world's first fully regulated digital asset fintech group. We operate out of headquarters here in Singapore as well as Switzerland. And on these two platforms, we serve a global client base of over 1,300 institutional investors, corporates, high net worth individuals, and other financial institutions. When we say we are a fully regulated digital asset financial institution, that means that we operate under a variety of licenses. In Switzerland, as I mentioned, we have another headquarters. We operate under a universal banking and security dealers license. And here in Singapore, we operate under a collection of capital market services licenses around the activities of fund management, corporate finance advisory, dealing in capital market product, as well as custodial services. So collectively, these licenses allow us to administer on our clients' behalf also over $2 billion worth of assets under administration, comprising primarily of crypto assets, but also fund products, as well as traditional securities. That's Signum in a nutshell. Thanks, Kay.
Thank you.
Excellent. Hi, good afternoon. My name is Jeremy Ng. I'm the co-founder of Open Eden. We're a fintech startup that is building a regulatory-first, blockchain-enabled debt marketplace that connects institutional capital to Web3 or digital asset builders. And our flagship product is a transparent and compliant and risk-managed high-yield cash management product that's MES registered. So my partner and myself, we came from traditional finance and crypto world. So I personally spent 20 years in investment banking. I was heading Goldman Sachs Asia structured product business before starting out Gemini Crypto Exchange Asia business here in Singapore. So really glad to be here. Thank you, Endowus, for inviting me.
Thank you. Catherine?
Hi. Hey, everyone. My name is Catherine, and I head up TZ APAC, which is the Asia adoption entity for the Tezos ecosystem. So what's Tezos? Tezos is a pioneering proof-of-stake layer 1 public blockchain. We've gotten over 70 million smart contract calls to date, over 2 million funded wallets, and really excited to be on this panel with my esteemed panelists. I'm happy to share my experience in crypto in the past 6 years. Thanks.
Thanks, Catherine. Anton?
Hi guys, I'm Anton. I'm the Head of FinTech and Innovation for KPMG internationally. Based here in Singapore. I'm a Kiwi originally. I've got some experience working in this space for a number of years across capital markets, supply chain, looking at things like payments as well, the fabulous ripples of this world. But very excited to be here on this particular session because DeFi, that's where it's at, right?
Yeah, well, I guess that's going to be the question. So before I ask you guys for your 20, 30-second definition of DeFi, if you're going to give it to your 8-year-old nephew or kid or whatever, which is going to be challenging by itself. But obviously we saw the Bitcoin white paper in 2009, right? Which timing was pretty circumstance given that we had the great financial crisis, as we know for those of you who were trading markets then. Following that, we had Ethereum coming through in 2014, which was the rise of the smart contracts. 2017 obviously saw ICOs, the first kind of initial hype, if you will, from a mainstream perspective. And of course, this crypto bear market for about 3 years, which saw the rise of DeFi, right? So with that said, and just, again, starting from the bottom with Gerald, what's your 20, 30-second definition of DeFi?
Yeah, I mean, I think the definition is in the name, right? Decentralized finance. We describe a new form of consuming financial services on a more decentralized basis, or more peer-to-peer basis, without the need for centralized intermediaries. And this might take the form of interacting with smart contracts or other more sophisticated use cases, for example, providing liquidity into automated market makers and the like. Yeah.
Jeremy? It's going to get harder and harder as you come down, but
see, you tested us. You didn't put this in the pre-read. So
yeah.
Thank you so much, Kate.
I tossed all that out, man. Don't worry.
I think just to add on that, maybe just one point, right, for decentralization, apart from the fact that it is taking the decision making, from one or two organizations, to the hands of individuals. I think the way I think about it is really democratization, right? That everybody will have the ability to consume or to access certain kind of offering or products, in this new format. And I think at the end of the day, you try to achieve the goal of, being more efficient, having cost savings, and everyone will have the ability to participate.
Thank you. Anything to add, Catherine? Or a different skew?
Yeah, I'll add on to what Jeremy mentioned about open participation. So with proof of stake governance, staking is part of a crucial mechanism in gathering consensus on chain and upgrading the chain in a smooth manner. So with the Tezos protocol, on chain, we've actually had already 10 smooth upgrades with the community without hard forks. So essentially, the developer teams in Tezos pioneered this core DeFi concept called staking. So this is where users lock up their crypto assets into smart contracts, and then they get rewarded in crypto as node validators for two crucial functions. One is to help secure the network and be rewarded for doing so, obviously, and also to enable community governance on chain so that they can validate transactions and pass proposals as one ecosystem. So this is where, of course, Ethereum is moving towards a proof of stake mechanism, which will hopefully go live by end of September. But we have to think about if, for crypto curious participants such as yourselves in the audience, like what sort of chain would you want to be a part of? With Ethereum, it's generally, their upgrades have been generally quite contentious with hard forks and rife with uncertainties. But then with Tezos, it's always been like a 99% uptime. That's boring, but we have smooth, stable upgrades. So that's my take. Thanks.
Awesome. Anton?
I think it's the, actually I'll go with Gerald at the bottom, I must be at the top. So it's the system-wide decentralization of traditional finance structures. So we exist on central clearing parties right now, banks, central banks, and I think part of the notion of the technology is to try and distribute that around trusted counterparties using smart contracts and all that sort of good stuff. Whether it'll actually turn out being like that's a different story, but that's the concept at the moment.
Okay, awesome. Anton, you've obviously been, amongst other things, global fintech head at KPMG. You actually represent the oldest institution up here on this panel, right? But with that said, we've actually had an insane boom in the DeFi space, as a lot of people know in this audience. A lot of that has been homegrown talent here in Singapore, which we're very proud. In fact, Singapore is one of the I guess you could say, key nodes in regards to crypto talent, know-how, and expertise, as I'm sure you know. We've also seen, quite a bit of earthquakes also as at the back of that, and regulatory push, and rightly so, with the likes of Three Arrows, Luna, and so on and so forth. But with that said, what would you say are some of the benefits for DeFi and blockchain businesses here in Singapore and other countries in Asia as a whole?
Well, a couple of things. For a start, you mentioned Terra Luna, so that'll get me started. That's my trigger phrase at the moment. But it's interesting to see that Luna just suddenly spiked, or the second version of Luna suddenly spiked for no reason last Friday night. And I think the sort of whole speculative element of that part of the industry is not good for people who want to create sustainable businesses. And I look at people on this stage here, they all want sustainable long-term businesses. So in that respect, I think the regulator here is very right to call out speculation as being the enemy of innovation as we move forward. But certainly I have a lot of respect for the talent that's invested time and effort in this particular part of the industry. It is our future. The technology is undoubtedly brilliant. The business models are less so. But where I see Singapore really excelling in the future is what sits in this room and beyond. We are an ecosystem. Our network effect is generated from investors, from talent, from founders, from regulators, from banks and the legacy institutions, all participating in this experiment that is the decentralized finance right now. And the other interesting sort of concept about Singapore, you mentioned Switzerland earlier on, is actually we're a small island in the grand scheme of things. We're not big. We're impressive. We're smart. But actually we're dwarfed by larger neighbours sitting outside this region. So we have to participate in the talent capital and trade flows around the world. So West Coast of the US being major shareholders in DeFi here is a good thing. Switzerland, the Nordics, London, all being part of that is great as well. And I think that's where we need to kind of embrace our experiment here in Asia has been actually perversely more international to be able to get more domestic and regional benefits. But forecast going forward is, this is going to be the growth part of our industry. It's going to hollow out a lot of the traditional rails that we see in the market. And we should expect to see over the next 10 to 15 years this really progress. In the next 5 years, I still think we'll be working out how it works systemically before we actually get to that point.
No, fair point. You've already touched on one of the questions I wanted to touch on, but with that said, and I know this is tough, but again, looking out, and you've seen a lot of cycles. We all knew the hype in fintech. It was supposed to revolutionize and change banking, and I think that was, from 10 years ago. Sure, of course. I guess it's debatable, but yes, it's definitely making impacts, right? But maybe not on the line of what was alluded to, as is generally the case with these things. But with that said, and going back on how you see the development here in Singapore, do you think there's maybe some pockets specifically in DeFi that will have maybe more tailwinds? Others maybe will have, more headwinds, just, from a consumer kind of, perspective. I mean, does anything stand out one way or another, or is it still a little bit too ambiguous at the moment?
So look, we looked at the investment trends over the last 3 quarters for the industry globally. No surprises here. I think we're all following the markets, right? So the last quarter was pretty terrible for inward investment into the space, apart from actually some of the underlying. So where are the smart investors putting money? It's in financial market infrastructure right now. It's actually not that easy to change a large financial system without having reliable infrastructure sitting behind even decentralized finance. So that's one area I think is going to continue to grow. Digital identity obviously underpins all of this. We still have regulators, banks and other key players who actually own the liquidity in the market who are very concerned about money laundering, scams, fraud. We've seen all the losses that come out of that. You mentioned ICOs earlier on. I don't know where all that money's gone, but it's certainly not gone to the people who invested. So this is a big part of the industry which is being invested in right now. I think that'll be critical going forward. And then you look at some of the protocols that are actually going to help on-chain and off-chain, start to work a lot more closely together. Those have been key for investors over the last sort of 2 quarters as well. So maybe some of the stable coins, the retail stuff, the algorithmic backed has taken a real punishing, and so it should have. But I think smart investors are now saying, actually, we're going for system-wide change. We need the institutional banks, we need the institutional market infrastructure to be able to be ready to embrace whatever use cases come down the pike. Certainly if you look at MAS, no surprises, we all follow the MAS. They've put a lot of money into tokenizing assets on Guardian. They've announced that with our friends at JP, etc. I think Partior is exceptional in how it's taking Uber into reality on cross-border payments, solving a real-world issue, which is small to medium-sized enterprises really struggle on liquidity and working cap. So I think, again, those areas are going to have tailwinds from the regulators. And I would argue probably as we sort of progress through this, we'll see more areas of, open up, not just here in Singapore, but once the regulators get their act together globally, and they're all over the place right now, give it about 18 months, I think we'll see the GFIN, the big 8 regulators work in lockstep to actually then start to provide the basis for proper regulatory and risk managed infrastructure and change.
Fantastic. Thanks, Anton. Catherine, so Tezos, Web 3.0, DeFi economy, you're up here representing one of the true ecosystems in the space, of course. How do you see that playing out over the next 6 to 12 months, next kind of 3 to 5 years in regards to, the evolution?
Yeah, well, that's a really, really long question, so I'll do my best to
perhaps.
unpack
Maybe
it.
top 1, 2 things that kind of come to mind, right? Because there's a lot of dynamic stuff.
Sure, no problem. So I'll share a little bit about how blockchain ecosystems can help contribute to the Web3 economy. So starting off with Web 2, right? With the Web 2 space, you have these like closed loop applications, Web 2 applications like Gmail or Outlook. They're built upon open protocols like TCP/IP, HTTP, SMTP, etc. But with the Web 2 model, you get to use these apps for free. I mean, Gmail's for free, but Google mines your data and then sells it to advertisers, right? So as the saying goes in the Web 2 space, if you're not paying for it, you're not the customer, you're the product. So with the Web 3 economy, open source communities, even within Tezos, Ethereum, etc., and individuals as well, rather than being monetized as a product, we are incentivized and rewarded in crypto to maintain and develop core infrastructure, which is what our blockchain ecosystems are made of. So this is where evolution is and innovation is a constant in our space. Like you have people like Jeremy and you have people like Gerald building on top of core protocol layers like Tezos. In fact, it's very important to actually find the right founders and backers to build with for any core protocol layer. And with the DeFi ecosystem, it's really important that whether you're a node validator, whether you're delegating your assets to a baker, in the Tesla ecosystem, we call node validators bakers, to ensure that, okay, is this accredited? Is this platform KYC and KYC compliant with regulators in your local jurisdiction? These are all things to think about as we have more institutional liquidity coming to the space in addition to retail liquidity. It's also a very interesting space if you're looking into alt assets because someone in the earlier panel was talking about how traditional finance, traditional capital markets have completely already have been extracted of their value, and so people are moving in, especially individual investors, into the alt asset space or digital asset space. So this is a very interesting space to play in, and as an ecosystem builder, I would love to see more innovative financial products being built in the DeFi space, and look forward to collaborating with my panelists on this.
All right, awesome. So just on this concept, we're always hearing, leveraging the power of blockchain, the ecosystems, Web 3.0, and there's obviously a lot of smoke and mirrors. But what would you say, and maybe there's 2 ways of approaching this, but what would you say are going to be the 2, 3 main things that businesses and governments can do to really leverage the power of blockchain correctly, net, right? Or what would you say is maybe the top 2, 3 things that they can actually do very, very wrong to not tap into that? I'll let you take the skew you'd like on that.
Yeah, so the way the space has evolved over the past 6 years when I've seen it grow, back then it was all about Bitcoin, as you mentioned, the white paper and financial inclusivity. And now it's about, okay, how can enterprises come in and utilize blockchain for their businesses? So I'm thinking the best way is smart contract functionality, just leverage trust minimize agreements, make sure that you have security benefits, select the right network. If you want to choose to build on a public network, that's great. If you want to choose to build on your own permission network, that's also fine, except the trade-off is that public networks are a lot more battle tested. You get to see more hacks happen, yes, but at the same time, you get to also stress test your network. Yeah. So with scalability and innovation, you get, of course, more speed of execution, higher TPS, uptime benefits, and a lot more. Anton has already mentioned PARTR, which I think is a great use case for cross-border payments. We also have startups in the space also working on safer ways to pool liquidity, to avoid another Terra. How do we build more sustainable DeFi products that are with proper risk management processes in place? Yeah.
Awesome. Thanks, Catherine.
No problems.
So we're going to mix it up, and we'll actually jump over Jeremy and go straight to Signum at the end with Gerald.
Thank you.
Gerald, big fan of Signum. One of my besties has just joined you out in Switzerland. If I recall correctly, I believe you were also one of the first banks to be licensed globally, if not the first out of the US. And with all of that kind of said, a lot of what you guys do evolves and deals with trust, right? Not just being Swiss kind of in the DNA, but what can you talk about, trust, the importance of it in what I feel is a very thematically, it's increasingly nationalistic world, increasingly by, polarization, friction. So, within the blockchain space, how can companies cultivate, foster, and maintain trust among stakeholders? Because that's obviously what Web 3.0 is, right?
Yep. Okay, I think it's a great question, also very timely. I think the audience assembled here, you guys come mostly from traditional finance, asset management, and some of the concepts that we're describing seem a little bit esoteric and far removed from your day-to-day. I can assure you it's not, right? Like in many ways, and I think we speak at Signum with now 5 years worth of interacting with the market, providing institutional investors, corporates, high net worths with a means to on-ramp into crypto and digital assets more broadly with complete trust and peace of mind. And we've seen, certainly in spite of the recent bear market slump, that the pace of institutional adoption continues unabated. So it might be a little bit far removed from your day-to-day right now, but I can assure you that your clients, many of them are already invested. If not, they're actively looking to invest. And one of the things that has come out of the recent market correction has been increased scrutiny and a regulatory spotlight on, I think, some of the bad actions and some of the bad behaviors in the space, to put it mildly. I think we've seen, that for some, in particular, the unregulated segment of the crypto and digital asset market more broadly, there was an absence of risk management and I think generally a lack of sound corporate governance. And in the end of the day, it was mainly the man in the street, the retail investors, that were left holding the bags. So for me, the way we rebuild as a community, I mean, firstly, we need to acknowledge that there's been a loss of trust. Many of the folks that invested, especially on the retail side, were not perhaps aware of the risk that they undertook when they parted with their life savings or portions of their savings to invest in the space. So the space needs to rebuild and regain that confidence. I think the first thing that digital asset companies should do is to be aware of the regulatory environment, the regulatory rules that apply to their business models, and ensure that if they need to be regulated, they should start the process of obtaining the necessary licenses to do that. We see increasingly more of the activities and more of the flows inexorably moving towards regulated players rather than unregulated players. Signum, for example, just to name it, to put it out there, we're not just regulated in Switzerland as a payments provider or with a secondary license. I think we undertook the hard yards of obtaining a bank license because for many of the activities that we provide the market in Switzerland, they require a banking license. I think if you are offering credit and lending services, if you are taking crypto as collateral and giving out loans against it, which some of the names that you might have heard, like the Celsiuses and the Voyagers of the world that are now going through a bankruptcy process, Many of them were undertaking these activities with actually no license to back them up. And I think this then lends itself to abuse, and it lends itself to a situation which they're facing, which is more like akin to a run of the bank. Because Signum is regulated as a bank in Switzerland, for every loan that we disperse, we have to hold regulatory capital against it. And if you think about it, that makes a lot of sense, right? Because you need the rules that apply to banks everywhere nowadays, the Basel III Accords. Those rules were hard-won, but they were instituted after hard-won lessons from decades worth of incidents and bank runs, and they are protections that banks then need to put in place to protect their customers from any cowboy type behaviors. And so I'd like just to mention one data point, which is we had the situation where of a contagion effect, a domino effect, where lender after lender, it seemed, was going under on the crypto space. But throughout this entire time, with the markets collapsing at one point by 70-80% from their peak, Signum Bank in Switzerland continued to have zero hard margin calls, right? Zero forced liquidation of client collateral. And we didn't do anything special. There was no special algorithm. I think most people think that it's some technology solution that can come and save the day. It's not. It's just very sound and prudent risk management policies set by an independent majority board of directors that have the necessary experiences on the banking and the traditional banking, as well as the lending and risk management side of things. So I think firms need to assess whether they need to be licensed, they need to be aware of the regulatory regimes that apply to them and will soon apply to them. And then on the other part, I think beyond just getting licensed, I think the other thing that digital asset companies need to do is to assess investor suitability, to judge for themselves whether or not the products and services they offer can be understood by the clients that consume them. And then finally, I think all of us have an ongoing obligation to undertake investor education and thought leadership, right? I think we need to continually evolve the market. We need to continuously bring the best practices to bear and share openly and candidly with our clients and stakeholders the risks, the rewards, of course, but also the many risks that accompany investments in the digital asset space.
Thanks. So just for the next question, and I'll try and make this one brief. It's a question I hate to ask you, but it's very valid. It's one I've been peppered with since 2014. But given the fact that you guys were also early, it's the big trillion-dollar question. When are we going to see mass adoption of digital assets? So it's not just DeFi here that we're talking about. For context, obviously, crypto used to be literally in the millions, and then we were a few hundred billion, and obviously in the 2017 cycle, we got, I believe, up to 800 billion, and everyone was wondering, will it go to 1 trillion? And of course, last year, we eclipsed 3 trillion, and I'm guessing we're around sub 800 billion. Now, I appreciate that actually doesn't give you the full picture, because actually what a lot of people miss about DeFi and crypto is the most interesting thing is actually not the price. It's actually what's happening in regards to the change in governance and models and so on. But with that said, sure. Mass adoption, is this going to be a tipping point? Is this going to be over time? What's your thoughts?
Yeah, I'm going to answer, and I'm sure there are others chomping at the bit to respond as well. I think you started with a definition, and so I think it's important when we talk about digital assets to understand that it's not just one single thing. It used to be that digital assets were synonymous with cryptocurrencies, but that's no longer the case, right? We have subcategories of digital assets, including crypto assets, but also security tokens / asset-backed tokens, and finally you have your central bank digital currencies / private stable coins. And each one of them is, I would say, at a different stage of adoption. Arguably, cryptocurrencies have already passed that tipping point from mass awareness into mass adoption. I just was reviewing some of the literature and the surveys that are coming out from the Accentures and the UBSs of the world. In June, I think Accenture estimated that in the region, Singapore, Malaysia, Thailand, Philippines, and Japan, I think, or Hong Kong, more than 52% of mass affluent investors already had invested in crypto. or held crypto, on their books. I think UBS had a report in the same time frame that suggested something similar. More than a quarter of wealthy family offices had already invested in crypto, and another 30% were looking to get in. So cryptocurrencies, I would say, they've already passed into. I think they've passed the trajectory is really onwards. If they're not already mass adopted, they are certainly well on the way to being mass adopted. Now, when it comes to, and I'll just won't address the CBDCs one. I think that one will move on its own timing on the basis of what the regulators deem is an appropriate cadence for these projects to be launched. But for the tokenized assets, so asset-backed tokens, security tokens, I think quite objectively, the asset class hasn't lived up to market expectations, right? I think that's putting it mildly. I think tokenized assets, when we were reviewing our business case in 2017, there were wild predictions that by 2021, we would see more than $2 trillion of asset tokens. I think last year, when we were looking through the results or the data, it seemed like if we achieve even 200 billion, that would have been a strong outcome. So we're off by a factor of 1,000x, pretty much. And I think there are many reasons why asset tokens haven't taken off. And there are many, I think some members of the audience that are probably more well equipped to describe those problems in detail. Sygnum is also has not given up on that front. I think we are the market leader in Switzerland. We have tokenized over 300 million worth of assets, continue to be pioneering new asset tokenization projects every day. But I think the challenge there is one of investor education and awareness, and also finding the right issuers or right products then to tokenize, and that continues to be a evolving situation. I would just make one plug there for a project that
a lot of people are just waiting for a date. It's like 9 months from now. Is it?
Yeah, no. I was going to say. Okay. Final comment. I say sorry for hogging the time, but I think for us, tokenization in the current form is probably less interesting than the hybridization of asset-backed tokens with utility tokens and NFTs, and offering them in a fully regulatorily approved sort of format. And on that front, just bookmark it a little bit. We have an announcement in a couple of weeks with one of the leading traditional companies in Asia that are launching its own metaverse, and we are going to be we've been mandated to help run a hybrid security and token issuance, and I think this is really the future of digital assets, and combining cryptos as well as asset tokens.
Okay, Jeremy. Last but definitely not least. So the first question I have is just a personal one, because I looked at your profile and I was like, this guy's insane, right? So being a student of risk reward, trader, investor, strategist, everything I look at as a cost-benefit skew. So you go into all the top-tier banks, Goldman, Morgan, and I'm paraphrasing some of this, so excuse me. Start in structured products, end up being the CEO of WealthTech, which is best in class, known in the finance space for their structured products, very good firm, excellent culture. You then start out the Asia office of one of the biggest known exchanges out there, which is Gemini, which should be the mother of all retirement trades, right? And then you leave. So, with that in mind, and obviously, however much you can share, what was kind of the rationale behind that? Because obviously they're considered potentially one of the better exchanges out there. They were very pro-regulation before a lot of other people were, which was very unpopular, of course, also back then, right? So it's also interesting to see that big move back. So I wish you could maybe shed us a bit of light on that, if you don't mind.
No, sure, absolutely. When I started the Asia business for Gemini, that was early 2020, which kind of coincides with the bottom of the previous crypto cycle. And 6 to 9 months later, then we have the mother of all bull market. So just saying, I'm starting now Open Eden. I'm not predicting what's going to happen in the future. But I think, at the end of the day, it is very much related to promoting adoption. Gemini is clearly a very reputable and regulated exchange.
But for the most part, it is targeted at retail investors. And at least in my view and my partner's view, is that in order for digital asset and as an ecosystem to truly grow, I think what we really need is for institutions like many of you sitting here in this room to fully adopt and embrace. But at that point, we feel that in the market, there isn't enough platform that has that focus. I mean, for good reason, because the retail market was more ripe for adoption. And, I've worked in banks for 20 years, and I understand how difficult it is to go to your compliance or legal team to get them to approve a new product. And I think because of that friction, most of the platform decided to focus on retail. But we truly believe that it is a technology, it is an ecosystem that institutions need to be involved in. But the only way for them to be involved in is really having regulatory oversight, having proper compliance and transparency. I mean, I don't know. How many of you here watched English Premier League? Okay.
Oh, come on, there's got to be a lot more people out there.
I know we missed the game over this weekend, but essentially, it is like the ecosystem is like a game of football, right? Football is a beautiful game. I'm referring to the British football, by the way. And regulation is not really here to change the way football is being played, right? It is the same analogy that I would think of as having your linesman, your referee, and I think even until most recently, your VAR, right, your virtual assistant referee. And it is to basically ensure that the game is played in a way that there are rules. And if you think about true freedom, right? People think about decentralization is like freedom. But true freedom can only happen when there are boundaries and when there are rules and there are framework. So people, the players know exactly, how to play the game. And I think that's why we decided to set up Open Eden to be able to create a platform that is regulatory first, that has compliance, in mind and transparency, and offering that investable layer for institutions to begin to kind of step foot into the digital asset space. So asking an institution today to kind of set up a MetaMask account, an online wallet, and plug in, converting your US dollar into stablecoin and then, putting liquidity provisioning into different pools is probably a little bit too much to ask for in 2022, hopefully in 2025. So they need a bridge. And we want to ensure that this bridge does not compromise the ethos of, decentralization, but at the same time, providing that platform that is trusted and have proper framework to ensure that the bad players, will not be able to kind of take advantage of the fact that it's unregulated and whatnot, and to do things that will harm, consumers at the end of the day. So that's a very long answer to my question, but that's why we decided to build what we're building Open Eden.
No, I appreciate that, and that also touches on this question about regulation and obviously the shift that's kind of been happening. With that said, and this was thematic to the last panel, it's of course a big critique of the people who look at crypto as an asset class for the first time. To say we've seen volatility is maybe an understatement. Going from 70K to 17.5 on BTC, and of course, some tokens have gone to zero. Obviously, these are not the same things, right? But it's also interesting to see that DeFi has continued to function throughout, right? The algorithms, the clarity, everything on blockchain has functioned as per the code. But just, given recent volatility of digital assets, what's your viewpoint when people ask, is this still a viable asset class for investors' overall portfolio construction, or people may be thinking about that from too linear a sense? I'd love to get your take, and then I would also love to get maybe Catherine also weighing in on that.
Yeah, sure. Today, I think number one, full disclosure, and I'm still holding on to my Bitcoin or Ethereum, and holding on to it, because I believe in it. Now, I think taking a step back, right? If you look at the digital asset space, it is not only about token or crypto prices. So that is almost like, in drawing an analogy to the TradFi space, is equating crypto token to equities or stocks. And we all know that, the whole financial market, is just not consists of the equities market. In fact, there is also credit market, which is 5 times larger than equities market. So there is actually also a credit market that exists in the digital asset space, and it's still very nascent, and it is actually, you know, in a spot whereby the risk-return profile is very interesting, because if you look at a credit cycle, you know, using a TradFi type of kind of analysis, we might have already seen the peak default, and we learned about all these major default, like, you know, hedge funds and lending platforms, and so there's a flush out of the poor or credit unworthy borrowers. So what you have left behind in the systems are actually companies that are battle tested to a large extent, that has demonstrated they have got good risk management, good business model. They're still surviving and thriving. But on the other hand, the supply side, you know, has been severely handicapped because, you know, obviously, you know, they got impacted quite severely on the balance sheet. So you are in this environment whereby, you know, there's a shortage of lenders in the market, and strong credit-worthy borrowers, and at the same time, credit spread has widened massively, you know, both in TradFi and also in the DeFi space. So I would say that, you know, the credit market, you know, within the digital asset space is actually something that is very interesting because, you know, obviously it is not as correlated to crypto prices and not as volatile. So I would say that, you know, clearly, you know, crypto prices, I personally feel that, you know, there's a long-term, you know, prospect to that. But I just thought it'd be interesting to highlight there's also a very interesting credit market in this space.
All right, great. Well, actually, let's switch stuff. And Catherine, I want you to kick us off. But this is going to be kind of closing thoughts on what are you most excited about? Could be DeFi, could be digital assets, it could be the firm where you're at. It could be, you know, let's just got the blank canvas. So.
Yeah. Honestly, this panel has been all about DeFi, but ultimately I'm long the tech. And September is a special month for me because this is the 4th anniversary of the Tesla's mainnet launch. So it's since we went on live in 2018. So I'm long the tech. It's definitely going to stay. And that's what other venture builders and crypto VCs in a space like A16Z or Katie Horn will think. And it's ultimately, okay, where are your favorite adoption verticals? Mine is the creator economy, because in the past 4 years, when I started looking at Bitcoin, it was all about Bitcoin price trends dominating Bloomberg headlines. And eventually, in the past 2 years, it was all about NFT art dominating mainstream headlines. And that I see has been a more inclusive narrative for mainstream adoption. So you have like Gen Zs just walking into art exhibitions and just, you know, just scanning QR codes and like just buying NFTs off open markets. So this is really cool for us to see as an ecosystem, and Asia as a region has strong growth potential for blockchain adoption in the NFT space. So watch out for that.
Awesome. Anton, 20, 30 seconds. What are you most excited about?
Actually, I'm really excited about the tokenization of physical assets. We've talked a lot about financial products today, but I think, you know, you talk around credit markets, for example, which I agree with, but there's a whole world out there of real estate and property and chattels that we own that could be given digital identities and could be put into the decentralized finance world. That would help with redistributing assets, and also would help with things like climate change and climate risk and rising sea levels. So that's the one I'm going to follow. And just answer your question before around how long? 15 years, I reckon.
15 years.
No time soon.
Appreciate that. Gerald, 20, 30 seconds. And outside of Signum, what are you most excited about in the space as a whole?
Yeah, I mean, for me, the most exciting thing is to work together with all of you guys, panelists, as well as the audience, to onboard the next 100 million investors into crypto and digital assets, right? I think the first 100 million wallets that we all know about have been characterized by direct token investments, so buying your Bitcoin, buying your Tezos directly. The next 100 million investors to come in will constitute clients of yours today, and they will be investing not just, you know, through tokens, but through fund products, through structured products, into tokenized physical assets or NFTs, and they're going to need the same kind of guidance and advice that traditional asset managers and fund managers, wealth managers provide them today. So I'm very excited to be part of this global movement.
Fantastic. Jeremy?
Yeah, I think what excites me the most is to be able to bank and serve the Web3 builders, to be able to finance the brightest minds that have taken that risk, to jump onto this digital asset journey. And as we're all aware, they are actually a group of unbanked people, unbanked companies. And that's why Open Eden is building this debt capital marketplace to able to connect them with institutional capitals, hopefully like yourself, to help them build up the future of finance.
Fantastic. Can we please give a big round of applause for the audience here and the panelists? Great job.
How's everyone doing? Okay? You've all had some coffee? Feeling energized for the last session? I can tell. Good. So, as the last panel discussion highlighted, I think a really important point, digital assets are not just about cryptocurrencies, and it will be interesting to see the evolution of the tokenization of real assets. Okay, coming up next, we've heard a lot about wealth tech, but wealth tech does not a smart investor make, does it? It depends on your financial literacy, and that is what we are going to hear all about coming up next. To be a smart investor, one needs more than just the right tools. Building financial literacy is also critical to understanding one's goals, your risk tolerance, and your investment options. This combination of tech and Finlit is what makes a smart investor. So to find out how we can combine those two to be successful, we're going to be joined on the stage now by Jamie Lee, Head of Content Editorial at Endowus, Lu Chengchuan, Founder 1M65 Movement, Haru Ming, who is the co-founder of the Woke Salaryman, Gerald Wong, founder and CEO of Beansprout. Let's welcome them all to the stage.
Okay. Well, good evening, everybody. My name is Jamie. I am the head of editorial and content at Endowus. I have with us three gentlemen who are on the panel. Rachel was supposed to be with us this late afternoon, but she sends her apologies. She's not well here. So our panel has the dubious honor of being between you and cocktails and happy hour right now, so the responsibility upon us is quite important. So we've told ourselves that we will be the crowd warmer to the happy hour session. This panel is quite aligned on what we're supposed to do, but we are here to talk about a very serious topic. So we will banter a little bit, but let me just first start out by talking about Finlit. As we know, this is a WealthTech conference, and thank you so much for being all of you here at the Endowus WealthTech conference, the first of what I think our bosses want to be an annual event. But we're here because we think that the WealthTech obviously has a lot of potential, and Finlit is obviously this way that we can marry what technology can bring us with what is out there as information. The difficulty, of course, is how do we ensure that the right information is being put out there? How do we ensure that technology is really a good enabler for the right kind of advice, the right kind of information that should empower everyday investors to doing the right thing with their money. So I'm very, very pleased to have three esteemed gentlemen here with us. Before we start, of course, we're going to have a round of introductions. Maybe we'll start with Gerald.
Hi, everyone. My name is Gerald. I'm the founder of Beansprout. We are a MAS licensed financial advisor that was just set up this year. And what we really want to do is to be able to provide expert insights to retail investors. So effectively, this expert insights, we want it to be something that is simple, something that is actionable, so that retail investors can make better investment decisions. Prior to starting Beansprout, I was an equity research analyst with Credit Suisse for more than 10 years. So whether it's serving retail investors or institutional investors, being able to provide investment insights is something that constantly excites me. So very pleased to be on this panel today, and thanks so much, Endowus, for inviting.
And Remy?
Yeah, hi everyone, my name is Remy. I run like a personal finance vlog thing. It's called Woke Salaryman, so don't laugh. Yeah, so we kind of try to use like illustrations and comics to try to explain simple concepts to people, saving, investing, budgeting. But we recently expanded to talk about more global issues. Why is there inequality? You know, how come some people are paid more than others? Why do governments tax people more? No, why do governments have difficulty taxing the rich? You know, other stuff like that. So a whole broad range of issues. So please check it out if you enjoy our little chat that we will have.
Hi, my name is Lou. I must first apologize that I am probably not going to be very. I wear a jacket, but this is. I'm probably going to use a lot of Singlish because I'm the only non-professional finance person here. Okay, and I run a movement called 1M65, which helps to educate people to become millionaires by 65 years old. I have an ambitious goal of turning 1 million people into millionaires. So it's 1 million times 1 million, I think it's 1 billion, something like that. So I have this kind of ambitious goal, which I cannot measure. So I don't know when I'll hit a success, but I think we have quite some early successes. The 1M65 movement is a CPF first strategy, which is a very rare strategy, and we'll talk about that later. And from there, we will grow quite a lot of very exciting strategy. I talk quite a lot on YouTube nowadays, so you can visit my YouTube channel if you are keen. Okay, with that, thanks for inviting us.
Thank you so much. And we actually didn't expect, but Lou is actually a firm endorser and advocate of Endowus to the point that he wore the T-shirt like all the staff here. So he's not staff, just don't ask him for directions or anything like that. But our very valued and advocate, and we're so happy to have all of you here.
And client.
And client.
Yes.
It's quite important. I think your CX advisor would be like, and client, that's very important. But we want to start with quite a bit serious topic, which is about the rising cost of living. I think it's on everybody's minds. It's on the headlines today. How should sort of personal finance be catering or tailoring towards this? What are some of the trends that people should be looking at, should be thinking about very carefully to get the good advice and do the best thing possible for their money? Lou, would you like to start?
Okay, thank you. So I think not just the cost of living, I think over the last 2 years, we've been hit by so many. It's rare to get one black swan event. For those people who don't know, black swan is like one of those hurricane and tsunami that hit us, right? It's like life giving you a slap on the face, that kind of thing. But now we have got a flock of black swan flapping all around us, every day. It's very chalat, it's like it's what I call SB, Sibei chalat, so it's like, and that's where, today I was just counting, how can there be so many black swans happening all together? We have COVID, when COVID died, then Omicron come and all this kind of thing. Then we have got the inflation problem, then we have got Ukraine war with Russia, then after that China got problem, supply chain got problem, and energy crisis right now in Europe, it's like unbelievably so many, which stresses the most important thing is that we got to have a safety net, that even the world collapse on us, we will still survive. I see a lot of Ang Mo here, excuse me, a lot. Maybe you're not, some of you are PR, thank you for joining us, but please contribute your CPF. Your CPF there's like one of those, in Hokkien we say sure eat, which means that, so it's like even if the world collapses on you, unless a nuclear bomb in Singapore, or more than 50% of Singaporeans are blind and voted the wrong government in and spend all the money, it will be an incredible, sum of money for that as a safety net. So I emphasize that because that is the anchor of my strategy. With that as an anchor, you will do very well, even whatever black swan crash on you or things like that. Thank you.
Remy, you want to take that question as well?
Yeah, I think I think lots of personal finance content deals with like investments and budgeting. I actually think there should be more focus on how people can earn more money, how people can become productive individuals when it comes to contributing to society. I think very often how much you can invest depends on how much you earn. And if you don't earn a lot of money, then maybe no amount of investing could help you get there. I think what many people also need to do is to learn like why all these black swan events are happening. Because I think if you don't understand these things, very often the reaction is to like, oh my God, my life is so unfair, it's the worst. Maybe it's not even worth trying. And I think that's what I see many young people becoming. They become dejected. There's a lot of like movements around the world. There's like the Life Flat movement. In Japan, there's the Hikikomori movement. Am I saying it right? I think so. It's the one where they retreat into
silence.
Yeah, retreat into silence. And then in Singapore, there's this thing called like BBFA. It stands for Bui Bui Forever Alone. So okay, hang on.
It will be entertaining.
Yeah. So these are people who experience some form of weight gain. Then they think they are no longer attractive on the market, and then once again they retreat into society. That's the main point. And I feel like if people can start to realize like the causes behind these life-changing events, they can start to tackle the root of those causes, and then maybe they can start to earn more money. So I think apart from savings and investing, people should talk about what skills are in demand. Simple things like how to negotiate for a salary. I think all these things are not off the table when it comes to personal finance.
Before we continue, I'd like to say that we are very strong believers in body positive comments. I'm very aware this is going on YouTube, so I just want to, for the...
Oh, yeah. I am also,
of the
No. I mean, when I reference the term, of course, I will have to say "Bui Bui Forever Alone." I think, yeah, that's just this.
Yeah, over cocktails, we can discuss more of the Hardware Zone forum abbreviations. It's where I always call Hardware Zone forum, the place where civility goes to die. So, over a couple of cocktails, I suppose we can discuss a little bit more. Gerald?
Okay, so if you have built out your safety net already, if you are building up your skill sets and am able to earn a higher amount of salary, then I think the next important thing to do is for the amount that you actually want to be investing, how do you make proper investment decisions? And this is not something that you just think about when the markets are not doing well, when the markets are volatile, but it's something that even when the markets are going up, how do you not be too greedy about it and would actually be thinking about whether the company has strong fundamentals before you invest in it? So I think the way to build the kind of resilience towards investing is really to make sure that you are making proper investment decisions. So only with that, you'll be able to understand why you continue to invest in a certain way. You have conviction around the stocks that you're holding on to. You know that your portfolio is diversified. You know that even in a worst case scenario like the Asian financial crisis, your maximum drawdown is to a maximum level. And I think those will provide you with the kind of resilience even when the market is going down, because you have actually thought through all of these questions in a very careful way.
Yeah. I think oftentimes there's a need to think about thresholds. What is your threshold? What is it that... And it brings about a lot of fundamental questions about yourself. I mean, maybe it's difficult for young people particularly to think about that over a 40-year period, because that may change too, right? Through life cycles and different parts of your life. But it actually forces younger people to plan a lot more ahead, especially when you think about inflation, right? Of course, Lou and I, of the different vintage, obviously the younger vintage you, but for myself, I graduated during the global financial crisis, and it was a very difficult time.
You don't look that...
Thank you. I was waiting for that one.
I thought she's just a girl. Okay. My wife is there. Don't be mad.
Hello, Mrs. Liu. But yes, we went through a lot of crises, and my friends and I commonly talk about that, and it often forces us almost to look for hacks all the time. A credit card hack, a savings hack, and you try and hack your way out of a certain uncertainty, but But beyond that, of course, it brings that importance of planning and thinking through, what does money mean to you? We have an advocacy campaign that talked about that particularly as well. But it just forces us to think about our relationship with money, which I find quite interesting. How about thinking about the internet? The vast information that is out there, right? You have a very personal relationship with money, and then there's so much information. And you're trying to marry all of that together. So for you guys who are obviously very vibrant content creators, when you think about the amount of misinformation that may be out there, but also the fact that it has to be so personal to the individual, how do you think about the kind of content that you create for good FinLit? Maybe Gerald can state.
Okay, so I think first and foremost, we need to acknowledge that there's a lot of information out there. The challenge that most of our users face today is not that they do not have information, but how do I actually distill down to information that is important for my investment decision? So I think what we have found out is that they want the analysis to be something that is concise, because a lot of people don't have time, they have their work that they are focusing on to be able to build their spending power. They want it to be something that is actionable, because it is not just reading something and not doing anything about it. So I think it is the ability to combine something that is simple, concise, and actionable that is what we need to be doing to be able to engage people in financial literacy. Because what they face is actually not a lack of information, but information that is actually relevant and actionable for them.
Yeah, I think it's I think the most effective personal finance content, in my opinion, also kind of inculcates like a philosophy of long-term investing. So it provides like a set of values that people can, to be in a very cliche term, like hold true, like hold close to their hearts. And then using this set of values, you can then analyze like whatever is on the market at the moment and see whether or not do those align with what actually long-term investing is. So I think that's what we try to create on our blog. Long-term investing values.
But is it hard? I mean, Endowus believes in long-term investing. This is the part where I point this out, our strategic passive asset allocation. But it's also hard to capture people's attention when you talk about long-term versus short-term punts.
Yeah, I mean, of course, if you look at last year in 2021, I think we were kind of like writing about, if you invest in the S&P long-term, you can get 7% returns. I think lots of people were just coming out like laughing at you. You're not going to make it. Have fun staying poor. I mean, so yeah. I mean, serious. They say stuff like that. I mean, you guys probably know this. So, of course, it is difficult, but I do believe that history is a good teacher, and people from last year who said have fun staying poor, probably they would have changed their mind this year because of certain events that have
certain events, yes,
have occurred.
Lou, what do you think? I mean,
we're not even talking about fake news. We're talking about even mainstream news. Right now, I just used the recent dip. Ever since the Federal Reserve tekan the interest rate, the inflation chalat with high interest rate. Just whack the interest rate really high. Then after the whole stock market, have a big tank and things like that. Then, a lot of people, one group of people will say, this is the end of the world. S&P is going to crash to $2,500 points, everything is going to die. Then there's another group of people who say, no, it's going to go up, every day I hear this and that coming out. That's just mainstream news. These are the gurus. Gurus got, people say this, got people say that. Then on top of that, there is fake news that come out. When you all mix all together, it's really very difficult to tell for an ordinary people, right? I have a different stance or a different approach to this. Maybe we don't need to read too much of this content, okay? You look at I don't know there's one Ang Mo here, maybe you don't eat Hokkien Mee, but the most famous Hokkien Mee in Singapore, to my opinion, Hokkien Mee is a wonderful dish. Please go and try, okay? It's at Old Airport Road, Nam Sing. Have you ever tried? Who has tried before? Never. Oh, a few. Chala, you must go and try. Unfortunately, uncle doesn't allow me to invest or invest in a company. But there's this store where it's always crowded. It's always crowded. I'll give you another one. In Newton Circle, the oyster omelette, Olua. Freaking long queue. Whole night, long queue. I don't think the uncle of both store, whose business is like cash is like coming in, I don't know like how much. I don't even care whether S&P 500 go up. I don't think he, read our content whatsoever, because his business is resilient to all these things, right? Maybe what we need to educate people is invest in a strategy that survives all these up, down, these black swan flying around, crashing their windscreen and things like that. So that's why boring way like by CPF first, S&P 500, buy. After that, go on with your life. Women, go buy your handbags. Guys, go drive your cars, go enjoy fishing and tour your work whatsoever. That's all we need to do. That's my take.
So Hokkien Mee is very important. Yeah, I'm actually getting quite hungry when I think about it. But there is also that challenge of being topical. For a lot of us as content creators, you want to jump onto the conversation, but you want to do it in a responsible way. But at the same time, you also understand that people are talking about it. So Rayming and I had a side conversation about crypto. How do you have a responsible conversation around a hot topic like that? But also make it relatable, but also make it digestible, but also have all that nuance go into that. It's a difficult thing for us to do. But
yeah, I think it's difficult to expect for content creators, but it's also very difficult to expect the everyday lay person to be able to read through, like let's say a 1,500 word article full of nuance. So I think a lot of responsibility actually lies with the reader itself. So actually we tried writing about crypto last year. Actually, what we found out is that most people have selective attention. When you say like, blockchain has great potential, everyone's like, oh my god, maybe I should go invest in so and so coin. But when you say like, you should also be prepared to lose everything, they kind of ignore that part. They kind of fixate on huge gains. And I think it has to be said that a lot of responsibility actually lies on the reader rather than the content creator. I mean, of course, this is not to say content creators should just go and like say, this coin is going to the moon. I think that is not what they should do. Content creators should strive for like the most unbiased, most nuanced content possible, explain all the risks. But it's not a magic bullet. End of the day, people are going to do what they're going to do. Content creators can only try their best.
How about yourself, Gerard? I mean, you came from the equity analyst point of view, right? So much jargon out there, not everybody understands, the kind of models that are put out there. How do you think about making it relatable, but also having to explain, very fundamental technical ideas?
Okay, so my prior background was an equity research analyst, so I'll push out like PDF reports, making buy or sell recommendations to maybe someone like Sam, who decide whether or not to take a meeting with me. So it was a transition from having to come up with a recommendation to institutional investors towards one that would try to raise awareness towards particular topics amongst retail investors. And the transition has been very significant because one of the first things we did was to test out one of these PDF reports with retail investors. And the feedback that came back was actually horrendous. It was not just in terms of the technical jargon, it was effectively the entire report. Like, it was too wordy, they didn't understand any of the numbers that went into it, even like a PE ratio. So effectively, it meant nothing to anybody. So that was when we did more research to understand what would it be really helpful to a retail investor that if I want to allocate a part of my portfolio towards active investing, what are some of the things that would truly be helpful to him or her? So the few things that truly came out would be, number one, they would want something that is credible. So there's a lot of information that is out there about what is actually being seen as credible, what is something that they can actually trust. I think this was one of the topics that was raised in the earlier panels. The next point is that it needs to be simple because people really prefer to be like going for shopping, buying things on Lazada or Shopee, rather than reading investment content. So that is where being simple would actually help in terms of the communication. And then the last part is really making it actionable. So it is not just understanding that, oh, someone without the knowledge towards investing should start with a robo-advisor. But if possible, we should actually think about providing the link to Endowus, setting up the account, because I think what they want is something that is actionable and knowing what they need to be doing at the end of the day.
Thank you. Thanks for a little Endowus plug. I'd like to point out also that we are launching a curriculum this month as well, so please continue to subscribe to endowus.com/insights. But let me go on to CPF investing, right? This is your love, right?
Passion.
Your passion, right?
Yes.
Why do you think it's not something that everybody has taken up? Why do you think there's still a gap in people understanding or wanting to take up CPF investing?
Well, you know, if you look back maybe 5 to 8 years ago, CPF have a very bad name. Yeah, it's people go to Hong Lim Park, uncle and aunties go to Hong Lim Park, you know. Wow, CPF chalui ya, Cenghu chalui ya, which means basically it's like a CPF Ponzi scheme, you know, that kind of accusation and things like that. It's
not that it is, just to be...
Yeah, accusation. Those days, very bad, you know, and then we have got really, it's actually quite colorful. You go there and see some of these riots, you know, not riots, sorry, protests. Protests, you know. So at that point of time, you know, when I first started the movement to educate people that, hey, you know, it's a get-rich tool, you know. They call me Mr. CPF. Those days when they call me Mr. CPF was an insult, it's not an affirmation, you know. And then when I appear on social media, you know, 80% of comments will be like, this guy is, you know, running dog of the government. You know what's running dog? You have to translate the Chinese, which means you are the lackey, okay, which means you are basically one of those paid people of the government. But we go on, we plow, we grow the community, we tell people, and I role model for people, you know, it's like, yeah, I show you, you know, really make a lot of money, you know, that kind of thing. It took us 5 to 8 years to actually swing the entire community over, and I still don't have 100% success. But I think we've got enough success. Today, when you hit 55 years old, in the past, everybody chung to take every single cent out, because for fear the government will eat your money, right? Nowadays, people leave the money there and beg the government, let me put in some more. You know, the world has changed. They ask, let you top up. So I think it's basically poor education takes time to really re-educate people to this thing. So we have got, today I think the world has changed where people now on 1st of January at 12 o'clock, they'll go in their account, click and see huge interest rates, and they flaunt their interest rate on social media, right? If you have been to Sydney and I don't know what community, people are flaunting their CPF interest. You know, I make 20,000, I make 30,000, you know, that kind of thing. So I think it's just a transition period to educate people, and I do hope that transition will move on into something even better. Yeah.
How did you build a community, you know, where you built a voice around trying to convince people bit by bit that this is something worthwhile doing?
Actually, it was an accident. I didn't want to do this. I'm not even in the finance community, which I think 80-90% of you are. So I was being invited by CPF because I got this very interesting strategy. I just top up the CPF special account and Medisave account at a young age, top it up, and then power compounding, $1 million. Then I started that, and I like most Chinese, Singaporean, you make some money, you quietly keep quiet, don't let people know, you know, that kind of thing. Then CPF found out and just say, hey, you make money, you know, never share the rest of the world, I must do that. I know. Public service, then emotional blackmail me. So I got to go to one of these forums, and so I was in Suntec City, one of these forums, and I gave a talk, and then you're all retirees at 55 years old. By the way, you guys, once you're not there yet, But you guys, when you reach 55, so you'll be invited to a talk like this. All the auntie, uncles, we invited them. They'll invite a speaker like me, come and tell everybody at 55, so what happened. Christopher Tan, where are you? He's also usually invited as well. So both of us are sometimes invited. But anyway, then we invited. Then they'll take a talk. In that talk, then I tell people, oh, if you put money at 30 years old and let it compound, you'll get $1 million. Then after the talk, about 20, 30 people crowd around me and just said, why didn't you tell me that earlier? Why didn't you tell me that earlier? Wow, imagine 30-year-old people and then all CPF officers all run one side, hide in one corner. Right? I kena all the, you know, that kind of thing. Then after the whole thing over, then I say, come. Why don't you tell them earlier, you know? Then I say, we tell no use, you tell. I say, I tell. You organize another talk, I tell. So for one talk, two talk, I don't know how I got dragged. Now it's the 200 over talk already I've given. Then at one point in time, I realized talk, no more voice already. I'm 50 years old already. So I started writing at one point in time. So I used to be a regular contributor at Dollar and Cents. And I started writing. And then later I started a YouTube talk. I don't know how I ended up that way. And so basically, the whole movement started. I now have a Telegram channel, which I don't go and manage. It has got, I don't know, 28,000 people there. I don't know how it started. So the movement just started, and I think that it's a great movement. Right? By accident, I didn't organize it, okay? By accident, the whole of Singapore got educated. Today, I'm so glad that the number of top-ups, the number of Singaporeans getting richer and richer at retirement is just a lot more. Fantastic, okay? I think it's just a movement by accident.
I think we should give Mr. Liu a round of applause, right? Because he did this out of goodwill and not doing this. Thank you so much for paving the way so that Endowus can talk about CPF investing as well.
We'll talk about Endowus
We are
later.
the only digital platform that provides CPF, cash, and SRS. So,
yes.
We are running a little bit out of time. There is a question out there, but I think I'll summarize it all together, right? For the two of you, how do you, for a young investor who's just starting out, how do you start that conversation with them? And then there's also a question about, are there better yields than SSB? The answer is yes. But maybe I think if you could broaden out the question to how should a young investor start investing, but also think about diversification, which may be quite boring, perhaps, but an important lesson to think about. So maybe that.
Yeah, I think one thing the young investor should do is to avoid chasing max gains, which is very tempting, of course, when you start. So for example, let's say there's something offering 12% on the market versus 4%. Obviously, the young person will naturally say, oh my God, I want the 12%. But what they do not know that in the short term, that 12% could go down like as much as 30, 40%. I think these are concepts people should know, but I think they do not know enough of. I think one way to get this perspective is to study historical events. So maybe even personal finance could educate people on things that happened in the past, Asian financial crisis, dot-com bubble, GFC, back in 2008. So for example, if people studied the dot-com bubble, they will know that a long time ago, there was a company called Pets.com, which had very high valuation and then crashed to the ground and became nothing. Maybe if they had that perspective, they would know that in the crypto space, there are many, many Pets.coms. So maybe it's about letting people see that, human nature tends to be quite consistent over the years. And the fear and greed cycle happens, very, very often, more often than you think. And each time people say, oh, this time is different, very often it is not different. Yeah, I think, that's one way. Over to you.
Maybe just to tie everything together, since this is a fin-lit panel, I think that is where knowledge can actually help to build the confidence among a young investor. And that's why he's here to share about CPF. Woke Salaryman is here and very popular. Dollars and Cents is spreading the personal finance news. And Beansprout is here to actually provide the investment insights, because we all believe that with the right investment insights, with the right philosophy towards investing, if you know what are the various tools that are available in the market, you'll be able to make a more confident choice. And I think that is what the young investor would need at this point in time, such that through the ups and downs of the market, he would have the conviction towards his entire investment philosophy and wouldn't be swayed by some of the short-term movements.
You know, I think all three of us are very committed towards FinLit, right, in various forms. And of course, you know, Woke Salaman has really paved the way when talking about using visuals. You know, I think Beansprout is really quite topical on this. And of course, Lou is here on CPF. I want to encourage everybody who's with us online and also in the crowd to continue looking at FinLit. And for all of us as partners here, you know, if you've had suggestions, at the end of the day, I think it's about empowering the everyday investor. And I think that's ultimately our message, right? To be able to democratize finance and to make it not difficult, to make it something that not everybody has to stay in their lane to understand finance. Finance is about your everyday life, and want to make sure that you are empowered with all that information. So continue to reach out to all of us, and with, you know, things like EWC and other events that are out there, and all of us are, I think, easily contactable, socials, emails, and like YouTube as well. I think continue to stay in touch with all of us, and if you have any suggestions on how to do FinLit better, please always approach any of us. I think the whole point of this is that, you know, with a lot of content, we're actually very open today, right? We are very easily reached, and I think that's the whole point, right? Finance used to be something that was very far away, and it's not something that you can touch today. So with all that colorful language that we've provided to you with this panel, it leaves me to thank the three gentlemen here and thank all of you for sticking around, and thank you very much for everybody.
Thank you. Thank you.
What an interesting panel, 1M65. And of course, a plug for my station, Money FM. That's what we're all about as well, helping investors make their money work harder for them too. Well, where to begin summarizing today's session? We covered everything from ESG to wealth tech trends, to financial literacy and how to improve your knowledge to work better with the apps that are coming out onto the market. I think one of the key things is it's really highlighted why sessions such as this are so important to really bring all of it together. A lot of the topics that we've discussed today are at such a pivotal point, from ESG, DeFi, crypto. You know, there's just so much evolution going on in the market. So as Jamie said, hopefully this is the first of many EWCs to come. Well, thank you everyone for joining us today. And for those who are joining us virtually, we hope you've enjoyed all the session. Congratulations to Endowus for the launch of EWC 2022. And of course, thank you to the partners that supported this event as well. A gentle reminder for guests who are proceeding to the cocktail reception, invited guests, please head over to the Straits Room on level 4. Thank you, everyone. Have a wonderful rest of the day and a wonderful week as well.